All right, welcome everyone. Welcome. My name is Mike. You guys will know me on Discord, Twitter, Instagram as 7-Star Mike. And today I wanted to go through some of the basics of support and resistance because it is the most common question we get in our Q&A sessions when we're talking about stuff during trading hours and we get direct messages. After hours, when someone's asking, how do I find where to enter a trade and where to exit a trade? It all comes down, for most of us in Black Box, to support and resistance. A lot of us are short-term traders. Even with swing trading, when you need to find where to enter and exit, we use support and resistance to find those points. So for those of you who are brand new to trading, I want to introduce you to support and resistance because it is a big part of what we look for when we're trading live. And it's really the basics for how we find where we're going to open and close trades. So it's really important to understand what it is, why it matters, and how we use it. So I'm going to try and go over that today. Support and resistance and technical analysis as topics are really in-depth. Today is just going to cover the basics of it. There are courses, there are books, there's so much information available for each individual piece of technical analysis or different support and resistance concepts. So if you guys want more information, there's tons of it out there. Today I'm going to cover, again, just the basics because I want to give you guys that are new to trading or struggling with where to enter and exit trades an idea of where to start. This by no means will be a comprehensive course on technical analysis or support and resistance. So if you've been trading for a while, this might not be very informative for you because it's probably stuff you already know. However, if you're brand new to trading, and again, based on a lot of the questions that I get from our Q&A sessions and from direct messages during the trading day about specific trades, is where do I enter, where do I exit, how do you guys know that's a good spot to open a trade? And again, all of that comes down to support and resistance. So for the new traders and for those who have never heard of support and resistance, again, we're going to cover what it is, why it's important, how we use it, and there is a chat section for you guys if you have questions. You can type into the chat box there. I am on multiple monitors, so I can't see the chat as it's coming in live, so I will go back and try and read the chat afterwards. I will pause a few times and maybe go back and check it out. So if there's a little bit of pause here and there, it's because I'm going to go switch between screens. I've got a few things on different monitors, so I'm going to bounce between the two to try and monitor the chat, but mainly focus on switching between what I'm trying to tell you as far as the topic, but then kind of mix in some real-time, real-world examples of what we're looking for. So a lot of times when you look at seminars or go to an event that's trying to teach something, they're going to give you the perfect example of what they're trying to teach you, and then you go out into the real world and try and use it, and you're struggling because it doesn't look the same or the feel is different. So what I'm going to do today is show you the concept that I'm trying to talk about, but then give you an actual chart that you can pull up on your own screen to show that it's not doctored. It is a real chart. Anyone can pull it up and see the exact same thing that I'm pointing out. So you're going to get the concept and then a real world example of where it comes into play. Not everything is going to be a perfect example. And the reason for that is because in the real world, not everything happens perfectly. So when we're talking about a support level, I'm going to show you an example where it might be a perfect support level, and I'm going to show you an example where it might not be perfect, but we still use it. So what I'm trying to do today is give you the real world support and resistance, the way you're going to see it when you're looking at charts, and the way I'm going to do that is by showing you actual charts. So again, there's going to be a little bit of pausing here and there because I have to switch screens I have multiple monitors in use here, so let's basically go ahead and get started on support and resistance. Before we actually get into this, go ahead and type in that chat box. How many of you guys are brand new to trading or have never heard of support and resistance, or you've heard of it but you don't really know what it's all about? Let me see if I can get a few of you guys in that chat box. Just go ahead and say whether you've been trading for a long time, whether you're brand new, whether you understand the basics of support and resistance, or you've never heard of it before. We've got one, you've heard of it. That's good, because if you're, and you use it, awesome. If you're new to trading, one of the main questions we get all the time is, how do I know when to enter and exit trades? And the way we trade, it's not everyone at Blackbox, but a lot of us at Blackbox, the way we decide our entries and exits is based on support and resistance. We have a 7-month trader, awesome. Long term for a few years, new to short term. Okay, support and resistance will help you out with short term trading for sure. The assembly station likes fibs a lot. I'm going to touch upon fibs in a slide, but I'm not really going to cover it too much because I don't really consider that basics of support and resistance, but I am going to touch upon just that it's a factor. Trading for 9 months, awesome. 4 years, we've got some relatively new traders and some relatively experienced traders, awesome. So there's a good mix in here. So what we're going to try and do today is make sure you understand what support and resistance is, and again, more importantly than what it is, how to use it. So when we talk about trading, there's a few different ways to base our decisions on what we're going to trade and how we're going to trade it. Fundamental trading is when you're looking at a company's balance sheet. You're looking at the strength of the company. Do they have debt? Are their sales increasing? Basically, you're looking under the hood at the strength of the company. What you're trying to do there is find a company that might be undervalued and pick it up now. 3 to 5 years from now, 10 years, 20 years from now, they grow into what they should be valued at, and your portfolio increases because you did the traditional buy low, sell high. So fundamental analysis is when you're really looking at the strength of the company based on the balance sheet. Momentum trading is anytime there's a ticker that might be moving quickly for whatever reason, whether it's news, whether it's a headline that just popped up, whether it's an earnings report, whatever the case is, if something's moving quickly, sometimes we take a trade based on that because we see the ticker is moving. Sometimes we don't know why, sometimes we do know why, but since it's moving, we're going to take a trade based on that momentum. So the company might be strong, it might be weak, but the ticker is moving at the point, so we're going to take a trade on that. Sometimes, if you guys are part of Blackbox, you've seen this where a news headline comes out and we're taking a trade strictly based on the news coming out. The reason for that is because when something comes out, news-driven, that's going to affect the stock, we're typically going to see a quick reaction to that news headline, especially if algorithms pick up on it. You guys have seen in the last few days, Boeing has reacted to a headline, and we're going to get a really quick move in one direction or another. So sometimes we're taking trades based on a headline or news that comes out that's going to affect a stock. Technical analysis is different from all of that, but it can help with all of that. So the fundamental guys are going to really look at a company, find out the strength, find out the weakness, find out what that company should be valued at, and they're going to decide to take a trade based on that. Then they're going to drill into technical analysis to find out where a good point to enter that trade is. When we're trading on momentum and news-driven items, we're using technical analysis to figure out where we should exit those trades perhaps where we should enter those trades. Where's the momentum drying up? If a news headline comes out and people are rushing into this stock and driving the price up or down, where can we expect it to maybe slow down? So that's what technical analysis is going to help us with. When we're doing our short-term trading, that's what we're really looking for with technical analysis. It's giving us a guideline of what we can expect. It's not going to be magic where we know a ticker is going to go to $300 and stop. We know it's on the upward momentum and we're going to get to 325 and stop. We don't know this stuff. But what we do know is that maybe at $300 or $325, there's a reason why it might stop. And that's the stuff we're really looking at to try and figure out when we're in our trades. And when it gets to those technical levels, we're going to look at what's going on to see if we want to stay in the trade or not. So technical analysis is really looking at these areas of where we can possibly expect things to happen. It doesn't mean things are going to happen, but it's what we're looking at for potential. So what is technical analysis? Technical analysis is a way to evaluate financial instruments by analyzing statistical trends from trading history, such as price movements and volume. So a lot of times when we're trading, you'll hear us say we'd like to see some volume come in here. So what we're doing is watching the price movement, we're watching the volume, and we're using those two pieces of information to help us make decisions on whether we think something's going to go up, if it's going to go down, and what kind of momentum it might have. Technical analysis uses patterns in market data to identify these trends and make predictions on future movements. So, let's take an example. You're a young kid. There's a stove in front of you. When you see the stove is black, you touch it, you don't get burned. When you see the stove is red, you touch it, you get burned. So you start equating when it's red, it means something, and I touch it, and I get burned. It hurts. Next time, maybe it's black, you touch it, you don't get burned. Next time it's red, you touch it again, you get burned again. The next time it's red, you're probably not going to touch it. And the reason for that is because you're using historical data to guide your decision. So every time that stove is red and you touch it, it hurts. You've done it in the past. Every time it's black when you touch it, it doesn't hurt. You've done that a few times in the past. So our historical data is guiding our decisions on whether or not we should touch that stove. When we're trading, what we're looking for is probability. There's no guarantee any trade we take can work. So we're looking for high probability trades. And the higher probability trades are the ones where historically we've seen when we're in this situation, it does this. Now that doesn't always mean in the future it's going to do the same thing, but historically, if 68% of the time something happens when you have this particular setup, we're going to take that trade and assume that 68% of the time in the future, we're going to get the same results. So technical analysis is using these historical patterns and trends and information to help predict the future movement. Now, we don't know what's going to happen in the future. Anyone that tells you, oh, Tesla's going to be $600 by another month or so, Tesla's going to sell off and drop back to $200, run, because here's the deal is that no one knows the future. No one knows the future. So no one can tell you what's going to happen with a stock. A lot of times when we're in after hours at night, someone will come into the chat room and say, hey, what's going to happen with Boeing tomorrow? And the bottom line is nobody knows because no one can see into the future. If you guys know someone who can see into the future, please pass them along to me because that would be an amazing person to have on your team when you're trading the stock market. It doesn't exist. So we're using these patterns, these trends, this historical data to predict what can potentially happen in the future. So when someone says, hey, what's Boeing going to do tomorrow? What we're really trying to get at is what could it possibly do? So have an upside scenario, have a downside scenario, because we don't know if the market's going to open green or red. A lot of times people look at futures and say, oh, we're going to have a green open. And then by the time it actually opens, those have changed and reversed. So no one knows the future. We're using technical analysis to predict what can potentially happen. And we're trying to use probability on our side to say there's a good chance this could happen, there's a good chance that could happen. So that's what technical analysis is really trying to help us out with. Here's one thing I want to point out to you guys real quick. This is the Facebook price target for the end of this year, for 12 months out. Analysts will look at Facebook and tons of stocks out there, and they will come up with an estimate of where they think this should be valued 12 months from now. Now, this is their job. This is what these people do. An analyst is paid to analyze a company and say to their company and to their clients, we think in 12 months, this is going to be the valuation of this particular company. So if you look over here, we have 48 analysts covering Facebook. Now, this is 48 people whose job it is to determine in 12 months, what should Facebook be valued at? The low is $120. The high is $342. So out of 48 people whose job it is to determine what Facebook should be valued at, there's one person that says way down at 120, there's one person that says way up at 342, and there's 46 others that are mixed somewhere in between there. So their job is to determine the appropriate valuation for a stock, and one says 120, one says 342. So they're not even close to each other. Facebook, at the time this report came out, was trading at 213. So one person thinks it's going to drop about $100. One person thinks it's going to go up about $100. So the analyst recommendations just goes to show you that the pros whose job it is to determine what a company should be worth, they don't know. This is their job. They have millions of dollars of capital and equipment on their side to determine what should Facebook be valued at in about 12 months. And they are widely off on their estimates. So if you have a short bias for Facebook and you think, you know what, I have information on my side, I've got all this data, I've done the research, I agree it should be $120 in a year. I'm going to take a short position because that analyst says 120. That backs up everything I was looking at. Guess what? There's another analyst out there with the exact same job title who thinks it's going to 342. So the bottom line is, if you look at that red text, the market does not care what anyone thinks. We'll say that again. The market does not care what anyone thinks. You can have all the research in the world that says Facebook should be valued at this $120 valuation. $120 per share. It's not worth anything more than that. I've done the research. I've got this on my side. This analyst agrees with me. Guess what? The market doesn't care what you think. It's not important. What is important is what is actually happening. That is the basis of technical analysis. It's what's actually happening to the stock at the moment. So we've seen a bunch of times Tesla will have bad news come out and the stock goes up. Boeing has had horrible news a few times and the stock refuses to drop. It took yesterday and today to see a drop on it, but there's been times in the past where Boeing has had horrible news and the stock refuses to drop. And you can have every indication on your side that your opinion is right. This company should not be valued as it is. It's overvalued. It's overextended. It's one of those stocks that just has people piling into it for unknown reasons. It's the fear of missing out, right? It's this ridiculous valuation. But guess what? Even if you're right, it doesn't matter. What matters is what's actually happening. Not what you think is going to happen, not what you think should happen, but what is actually happening. And technical analysis is what's going to give us the actual occurrences of that particular ticker. Are people in buying and selling? If they are buying or selling, where are they buying? Where are they selling? Technical analysis will tell us that. Regardless of what you think should happen, technical analysis is going to tell us what is actually happening. This is from Investopedia. Support and resistance. The concepts of support and resistance are undoubtedly two of the most highly discussed attributes of technical analysis. Part of analyzing chart patterns, these terms are used by traders to refer to price levels on charts that tend to act as barriers, preventing the price of an asset from getting pushed in a certain direction. At first, the explanation and idea behind identifying these levels seems easy, but as you'll soon find out, support and resistance can come in various forms, and the concept is more difficult to master than it first appears. Now, one thing I want to point out, if you're new to trading and new to support and resistance, it can be very, very confusing. Like anything you try to do that you've never done before, it can be confusing. However, if you spend time in front of your charts and you practice and you watch what goes on without trading necessarily, you draw some lines, you watch these levels, you're going to get a better feel for it and be able to do it in real time without really having to stop and stare at a chart. And if there's one of those charts where you do have to stop and stare at it and really figure it out, that's probably not a good trade to take right now because there's too much noise in there. There isn't a clear trade. So you'll get to a point where you can look at a chart and you can pop some lines in there of various types, and you're going to be comfortable saying this is a good entry, or I'm going to hold off on an entry right here. Support and resistance, it's not just drawing lines on a chart. It's what do those lines actually mean and interpreting what is happening around those lines. So we can all throw lines on charts. Some might be accurate, some might not be. The lines themselves don't really mean anything. It's what's going on around those lines. What do the lines actually represent? What we're looking at is the size of the candle around those lines, which is going to give us the indication of momentum, and we're looking at volume. And we're looking at what those lines represent. And I'm going to show you what those lines represent throughout this presentation. All of this sounds great, but does it actually work? So here's the thing. Years ago, you would never hear any mention of technical analysis on TV. It was kind of the snake oil from the big analysts, right? Technical analysis doesn't work. It's hokey pokey. It's not really based on anything. These days, CNBC has technical analysis segments. Kramer has it on his show from time to time. It's finding more and more acceptance. It's extremely common to use now as a trading tool. It isn't snake oil. It isn't magic. It is market behavior and psychology. Technical analysis is market behavior and psychology. And I'm going to show you that. Sometimes it's going to work just because everyone's looking at a chart the same way, and it could be a self-fulfilling prophecy. So if there's a ticker trading at $95, and it goes to $95.50 and $96, and it's probably going to go to $100 because everyone's looking at that chart. Everyone's looking for it to go to $100. If it's $96 and everyone's saying it's going to $100, well, you should probably get into the trade, ride it up for $4, and see what it does at $100. So if everyone's looking at a chart saying this ticker should go up $7 before it finds resistance, if it's $7 away from where a lot of people think it's going to go, a lot of people are going to buy it, hoping to ride that $7 movement. So just by looking at a chart the same way for a bunch of people, that might be the reason it goes to a specific level and stops. So sometimes it works just because it's a self-fulfilling prophecy. Either way, I'm going to show you why it's important over the next few minutes with a few different slides and examples. So now that we believe in it, let's understand what it actually is. Support and resistance. That's what we're here to talk about today. Support is an area on a chart where a ticker has a hard time breaking below. This is going to be a demand area. There's a lot of demand at a specific area for specific tickers. That's the support level. This is an area where a ticker is going to drop, 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 drop. And when it gets to this point, buyers are going to step in and buy it and continue to buy it, driving the price upwards. So when a ticker is dropping, think of support as where the price action is bottoming out, and it's kind of like a floor. A ticker is going to drop, and there's a point where it's going to stop and kind of bottom out, and it won't break below that level. So support is kind of like a floor where it's dropping, 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 and then it gets to a point where it just won't drop any further. Resistance is the opposite. So resistance is an area on a chart where a ticker has a hard time breaking above, and that's because it's a supply area. So when a ticker reaches that area, sellers are going to step in and start closing their positions or taking a short position, and you're going to see things climb, 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 and then they seem to top out at a certain point. So resistance is kind of like a ceiling. So support and resistance is just another word for supply and demand. And let's take an example out of the stock market. Let's say you're on a car lot. There's 10 buyers on this car lot, and there's one car on the lot. You're all looking at that car. Someone goes up and sees the sticker on the car is $20,000. All 10 people want that car, but there's only one of it. So someone else is going to go up to that salesperson and say, you know what? You want $20,000? I'll give you $21,000 for it. I want that car. Now there's 9 other people that want that car. So someone else is going to say, I'll give you $21,500 for that car. And someone else is going to say, I'll give you $22,000 for that car. So supply and demand is going to say that there isn't a lot of supply, but there is a great demand. The price is going to go up until the point where people don't think it's valuable anymore. If we flip that situation, you're the only buyer on the lot, but there's 10 cars on the lot. The salesperson is trying to sell 10 cars. You're one person on the lot. The sticker says $20,000. You look at the car, you say, you know what, I like it, but you've got 10 of them here. If it was worth that much, I think you'd probably sell these. I think you're overpricing this car. It's $20,000. You're having a tough time selling. I'll give you $19,000 for it. And if there's 10 cars, but there's only one buyer, they're probably going to drop the price to make that car more attractive to you because there's only one person looking to buy it. So supply and demand is really what's driving tickers up or down. Supply and demand is what moves a ticker. The more people that want a specific ticker, that's going to drive the price up. And when enough people have it and don't want it anymore, that's going to drive the price down. Support and resistance are basically just supply and demand zones. So when we talk about support and resistance, it's not magic. Sometimes it seems like it is because you can have a line drawn on your chart from 6 months ago. You don't look at the chart. For whatever reason, 6 months later, you pull it up and it's respecting that area 6 months down the road. It seems like it's magic. It's not necessarily magic. It's support and resistance, which is supply and demand. Here's an example of support. This line on this particular chart is $24.33. You can see this ticker is dropping. It has a few pullbacks. It drops, full pullbacks. It's got the impulse and corrections here. When it hits this line for the first time here, it bounces upwards. It continues its downward trend. It goes to that same point, and it bounces upwards. It starts dropping, has some upward movement, drops. When it hits that same point, it bounces upwards again. You can see 2 more times. So when I said think of it as a floor, again, the ticker is dropping, dropping, dropping. Every time it gets to this particular point, it bounces upwards. So it has a hard time breaking below this level. And the psychology behind that, again, there's demand for it at this price. So up here, I don't want this ticker. Over here, I don't want this ticker. Still don't want it, still don't want it, still don't want it. At this point, a lot of buyers will come in and say, you know what? This is cheap enough. At this point, I think I'd like to own it. And then it starts going up in price because a lot of people step in to buy it. As it's dropping, 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 the people that previously bought it over here might say, you know what? I initially wanted 1,000 shares, but I only got 500. It's at the same price again. Here's my chance to get another 500 at the same price. And now I have my 1,000 shares. A lot of people step in to buy it, and it drives the price up again. It goes downward. It gets to that magic level, and buyers say, you know what? It's attractive at this price. I'm going to buy it, and that drives the price up. We had this big movement up. That's probably an earnings-related open. And then it sells off. But it sells off right to that same point where people previously decided this is an attractive price to own this particular stock. When it climbs again and drops, magic, it's at that exact same spot. So support is a level where when you see the price dropping, it hits that level and bounces up. Hits that level, bounces up. Hits that level, bounces up. So think of it as the floor. It's having a tough time breaking below this point. A lot of times when people are asking for advice about trades, when we say if it breaks support, get out of the trade, here's why. It bounced, it bounced, it bounced, it bounced. When it finally broke through that level, it's nowhere near that level again. The price here at this point, whenever this slide was, some of these slides are going to be a little old. I actually prepared this a while back. So this is 1765. The line we had was 2433. So as long as you're in at 2433, you're fine. It hits that level and bounces upwards. Once it breaks that support, and we say if support breaks, get out of the trade, if you're in at 2433, it's now 1765, and it's nowhere near coming back to this level. Now, 3 months or 6 months, it might. Maybe another earnings report, it spikes up, it might. But you can see once this level of support breaks, there's a nice downward movement. And even when it starts going upwards, it's still nowhere near that support. So support is a level that a ticker has a hard time breaking below. Once it does break below, you don't want to be in a long position here because this is your target somewhere up here, and it's now nowhere near that level. So support, 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 support. Everything's looking good. Once support breaks, if you're in a call position or if you're in common shares, you might want to think about closing that position because it is now dropping. And you'll see in a little bit that it's going to have a hard time getting above this level once it breaks below it. Resistance is the opposite. So I said before, think of resistance as a ceiling. We're below this level. We bounce, we hit our head, we drop. We bounce, we hit our head, we drop. We bounce, we bounce, we bounce, we bounce, we bounce, and we bounce. And every time on this particular chart, it's 4470. Every time we hit 4470, we get rejected and drop. So if you think about the definition again, resistance is a point where a ticker has a hard time breaking above. Here it tries multiple times. It spends a few days out of it. This is actually, if you look down here, you'll see September, October. So this is the course of an entire month. We finally get back up there again. It gets rejected. An entire month goes by. We get back up there. It gets rejected. This is another month has gone by. It tried 1, 2, 3, 4 more times. It got rejected. Every time it gets rejected, it gets pushed down. So if you're in a position for this particular ticker, let's say it dropped down here and you bought it down here because you thought it was an attractive price down here. You see that it gets up here and sells off. You see that it gets up here and sells off. You see that it's sold off at that level multiple times in the past 6 months. That's probably an area where you want to look at to exit your position. And the reason for that is if you're in way down here and you know that it can't get above this level, the next time it gets up there, it's going to pull back. Now, we don't know this for sure because, again, we can't see the future. But if we have this 4470 level on this particular chart drawn, and we know that it's having a tough time getting above that level, and you're in a position down here and it gets to that level and starts dropping, My slides keep switching on me. Hold on a second. There we go. So again, if you're in down here, and you know that every time it gets to this level, it drops, guess what? That's pretty good information to have on your chart that 4470 is a level to watch. And again, if it can't break above that level, look what it's doing. It spent almost 6 months below that level. So if you're in a position down here and you're waiting for it to go way up here, when you see that it can't break above this level here of resistance, you might want to hold off on that position. You might want to close it out and wait for another time to get into it, because now you spent 6 months down here. Not only have you lost at this point half of your investment or your trade, or if you're in an options position, even more so because of time decay. So you've lost the amount that you put into the trade. You've also lost 6 months of time where you could have put that money to other use. So resistance is a point where the ticker has a hard time breaking above. And this is a pretty clear example where every time it gets to that level, it just can't break above that. That is support and resistance. That's the basics. That's what we're looking for today. So, I'm going to switch screens, so bear with me here. Let me see if there's questions, because I can't see that screen at the same time. There's one I see, Charles, you use pivot point and VWAP for support and resistance. Yes, I'm going to get to some of that. There's multiple forms of support and resistance. I'm going to try and show you some of that today. Not every example, but I'm going to show you a few different ways we look at support and resistance. That's actually the next thing coming up. Michelle is asking, is there a reason for that? And Charles answered it perfectly. Some stocks you'll see will respect a particular type of support and resistance. So depending on the ticker, some of them are going to respond to a moving average. Some of them might respond to VWAP. Some of them might respond to hand-drawn levels. Some of them might respond to Fibonacci levels. There's all these different forms of support and resistance. All these different forms of support and resistance are giving us different levels and different things to watch, but they're all telling us the same thing, where every time it hits this resistance, it gets pushed down. Every time it hits this support, it bounces. Now, it's not every single time, and I'm going to show you when we look for the break of that support and resistance and how we can use that information for entries, which is the big thing we're looking for, right? We want to understand what support and resistance is, but more importantly, we want to know how we use it to time our entries and exits. And that's the bread and butter of what this is all leading up to. Phyllis, what time frame do you use for measuring support and resistance? I am going to get to that later on. So I'm going to skip that question for now. It absolutely will be addressed. The short answer is your time frame has to measure, or it has to mimic the time frame of your trade, and I'll explain that later. So support and resistance can be done on multiple time frames. You can do it on a 1-minute chart. You can do it on a monthly chart. You can draw a chart out for 10 years where every candle shows you 1 month of action, and you can draw support and resistance. And I have an example of that in a little bit as well. So I'm going to show you some different time frames. So let's go back to the presentation. There's two types of support and resistance. We don't use the term static and dynamic when we're trading. But I want you guys to understand the difference of static and dynamic support and resistance. So static is basically lacking in movement, action, or change. Static support and resistance is going to be a horizontal line or a sideways channel. I'm going to show you examples of that. Dynamic means constantly moving, right? There's change. So dynamic support or resistance, the actual dollar level that's acting as support or resistance will change, but every time it hits that particular marker, it's going to act as support and resistance. And that might be confusing now, but in a moment the slide is going to kind of clear it up perfectly for you. Dynamic can be trend lines, moving averages, or VWAP. So moving average is going to fluctuate. It's going to go up and down. The level, the dollar amount of that moving average is going to change throughout the day, throughout the week, throughout the month. But every time a stock hits that level, it might bounce. Whether it's up or down, it might hit that level and bounce every time. Now, the actual dollar level of that is going to change, but every time it hits that line, whatever level it's currently at, it's going to bounce. So I'm going to show you that. So static and dynamic, again, we don't use those two terms when we're saying, oh, it's at a static resistance right now, or it's at a dynamic support. But what's important to understand is that sometimes it's a specific dollar amount that we're looking for. Every time it hits $50.70, it has bounced in the past. We're going to look to see if it bounces again the next time it approaches. And sometimes it's a different number. So the moving average is currently at $50.70, and it bounced off of that as support. An hour later, the moving average might have adjusted to $60.13, and it is bouncing off that as support again. So the dollar level is changing, but the line itself, whatever level it's actually at the moment, is still acting as support or resistance. And those will be a little more clear as we get into this presentation. So static, I mentioned, is horizontal line. You can see here, this is just a straight line going right across the screen. And here's 1, 2, 3, 4, 5 times that every time it hits that level, it bounces. It hits that level, it bounces. Hits that level, bounces. Hits that level and bounces. Hits that level and bounces. So if you're in this particular trade, do you think it's important to understand this 155.54 level for this particular ticker at this particular time frame? Is important? If you're in this particular trade, do you think you want to know something about that 155.54 level? And it doesn't have to be an exact number. Since it's close enough to 155.50, we can round it off. But there's something about 155.50 that once it cleared that level, every time it reached that level, it bounced higher. Multiple times. There's 5 times in, this looks like about a 4-month window. 5 times in 4 months, it gets to that level and bounces. So whether we know why 155.50 is important or not doesn't matter. What's important is that we know that it does matter. We don't have to know why, but we have to know that it does matter. There's something about 155.50 for this ticker in this time frame. There's something about it that when it gets to that level, buyers are going to step in and buy more of it, driving the price higher. Whether we know why 155.50 is the magic number, not necessarily important. What is important is that we do know there's something about 155.50 that we should be paying attention to. If we're in a trade, we need to know this information because every time over the course of 4 months, it hits this level, it bounces. So if you're in it here and it climbs and then drops and you want more of it, this is a good spot to buy more of it. It climbs again. It drops. It climbs. It drops, it climbs. So there's something about this level where you know you can add to your position or open a position, and it's a pretty low risk entry because in the past 3 or 4 times when it hit that level, it bounced and went higher. And if you're in this position, let's say you followed it here, 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 and you're going, oh man, you know what? I missed it 3 times. If it hits that level again, I'm going to buy it. It hits that level. You're in the position. It goes up here. You're thinking, oh man, this is an awesome trade. It comes back down. You go, oh man, I lost my profits. But yeah, I'm not losing money yet. I'm going to stay in it. It goes way up here. You're going, oh, awesome. I'm back in profitability. This is such a great trade. And it starts coming back down again. You go, okay, that's okay because every time it hits this level, it bounces up. So I lost my profits. I should have taken them, but I didn't. But that's okay because every time it hits this level, it bounces up. When we say, when support is broken, exit your trade, this is why. This is the time it did not bounce up. It did it 1, 2, 3, 4, 5 times. At some point, it's going to be a point where it can't sustain that anymore, and it goes from 155 to 130. That is a big drop. Now, if you stayed in the position, at some point you would be profitable again. But if you're way up here, you're in at 155, it goes up to 170, and then it goes down to 130. What you don't want to do is go here, say, okay, well, it broke support, but it'll come back. Yeah, it broke support again, but it'll come back. Oh man, it keeps breaking. Wow, this is just horrible trade at this point. I've lost too much. I can't stay in this trade. I guess I have to sell it. It goes way down here and you finally sell it, and then what happens? It goes way back up there. So how many of you guys have done that? It broke support, but I'm going to stay in it because it'll come back. Oh crap. It'll come back. Oh crap. It'll come back. Another red day. Oh man, you know what? At this point, I just have to cut it. Boom. That was the bottom. And then it goes right back up. You don't want to do that. You want to find where these support and resistance levels are, and you want to make your trades based on the information that's going on around that particular level. I am using a different mouse, and I keep hitting the wrong button. I apologize for that. So, again, if you don't understand what's important about that level, it doesn't necessarily matter. What matters is that you understand that level. Okay, so we need to know where these levels are on our chart so that we're not entering a trade right up here thinking it's going to go way up here. If we know this is a support level, we want to enter this trade as close to this level as possible, because every time it gets to this level, it bounces. So if we're way up here and we're going to enter a trade, we're risking that it's going to go all the way down here. If we're here and we enter the trade, if it breaks this support, we can get out of the trade without a lot of damage. The reason for that is because we're in right at this support level. So when support breaks, we can get out as close as possible to that support. If you're in way up here and it goes down to test support and it holds, you're looking good. If you're in way up here and it's this case where it doesn't hold this time, you're letting it go from 165 to 155 before you even realize whether or not support is going to hold. And then if it doesn't and you get out at 150, that's a big drop. But if you're here at 155 and support doesn't hold and you get out at 150, you've lost $5 per share. That's bad, but it was still a good trade because you followed the right rules. It's bad to get in at 165 and get out at 155 or 150. So we're going to use these support and resistance levels to help us time where we should enter and exit trades. So again, I want to drill into your heads. It's not important necessarily to know why that level is significant. It is important to know that it is, for whatever reason, a significant level. So let's do this. Let's look at an actual chart. This is eBay. This is a 1-year daily chart for eBay. You can see here we had a big candle wick that got pushed down. Over here we had a candle wick that stopped. This is the actual candle where I drew this line. If you look later on, that point where it couldn't get above, when it finally broke through, it's now holding above that line. If you look here, there is a wick that breaks below it, but it closes above that line. If you look right here, it held that line, it climbs, it drops, magically it drops right to that same line, and then it climbs again. You can see there's a little bit of noise in here where it does break below it, but then it quickly gets back above it. So in a real world example, this particular point where it had a tough time getting above, it's now acting as support, but it's not necessarily that exact line that's going to hold as support, because this day it closed below that line, the very next day it opened above it. And the next day it opened above it, and the next day it ran. This day it closed below it, but the next day it opened above it. So when I say it's not an exact level, on this chart it's 38.94 just because I used the high of this candle to draw the line. And then we're going to use that area as support. So we can say it's roughly $39. So the low of this candle is 38.54. So there's a 50-cent buffer zone in here where it's support, it broke through it, but it's not dropping all the way down. It broke through it, but it's not dropping all the way down. So it's not an exact $39 level, but this area is where we're going to be looking at for support once it breaks through. Because over here it had a tough time breaking above it. So right now this is resistance. When it breaks above that level, it's coming back, and that level that was resistance is now support. And that's an important concept I'm going to go over in a bit also. But what's important to know is that it couldn't get above this level here. When it finally did, when it drops to that same level before bouncing again. So that's one of those levels that if you're in this trade anywhere in this time frame, you want to watch and see what's going on when it gets towards that $39 area. It drops a little bit, it closed below it, so depending on your type of trade, that might be your exit. When it drops and stays below it, that's a good indication that you do want to get out, because again, once we drop below that level that was a support level, we're going to look at that level as a new resistance, where it's now going to have a tough time getting back above that level. And you can see it tried to a few times. It even closed above it for a little bit, and then this has to be earnings for a big gap down. So if we go to the other side of things, we have support, 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 resistance, support. So this line that we can draw back here in March is the same line that holds true for April. The same level that holds true for June. Now it's acting as support in November, or resistance. And over here it's support in December. It's kind of messy in this area. It's not respecting this line exactly, but you can see how we can draw a line in March, and a month later, it's still holding that level. And then over here we can see that it's having a tough time getting above that level. So if we have this line drawn back in March, we can see that as this ticker is dropping, where will it stop? We don't know. But what we do know is there's a probability of it stopping here. When it does, that's a safe place to enter a trade. When it drops again, but it doesn't break below it, that's a safe place to enter your trade. And in this case, it went from 35 to 42. Doesn't always work out like that. So it's a good idea to have this line on your chart, because for whatever reason, once, twice, 3 times, this ticker is respecting this level as support, which means every time it hits this level, it bounces upwards. It doesn't mean it's going to do that every time, but again, as traders, we're using probability, and in the past, historically, when it gets to that level, it bounces up. We're going to use that information to place a trade based on predicting the future, that when it hits that level, it's going to bounce up. There's at some point in the future where it won't, and that's what we're looking for. You can see after this big gap down, it closed above that level. You can see the wick here. It did go below that level, but it closed back above it. And then the next few days, it spent time above it. So when this level is important here, here, and here, and we're now trending way up here, but there's a gap down, and it gaps, but magically stops at this same level. My question to you is it important to know that this level exists? Okay, so it's support, it's support, it's support. Big gap down, it closes above that support level. And again, it's kind of messy up in here, so it's not respecting that level throughout this time frame. But the initial drop, it broke below that, but then it did close above it. So it is respecting that level for the time being right now. And then when it breaks below it, you can see this candle can't get above that level. So again, 35.50, there's something about that level that we want marked on our chart. Whether we know why that level is important or not, doesn't matter. But we do want to know that it is an important level. Let's go to another example. Here's Pepsi. This is a 1-year daily chart. So you can see that this level in here, there's once, twice, it can't get above it, 3 times, 4 times, 5, it can't get above this level. That is resistance. Every time it gets to that level, it has a tough time breaking above it. Over here, we had resistance and resistance. It had a tough time getting above this level. So let's say you're in a trade way down here somewhere, and it goes up here, and it starts dropping. And then it goes up here again, and it starts dropping again. So again, depending on the type of trade, that might be your indication that it's having a tough time breaking above this 135. If you're in down here at 115, 116, 118, 120, somewhere in this area, and you know it's having a tough time breaking this 135, when it hits it again, you might want to exit your trade. Now again, these are perfect lines that I've drawn because there's a resistance level right here. If I draw that line, you can see once, twice, even a few candles in here, it has a tough time getting above. So if you're in a trade down here, you can say, well, why isn't this resistance? Well, it is. I'm using this one just to show you an example of time going by and that same level holding as resistance. But this is also resistance. This is also resistance. You can see it 1, 2, 3, 4, 5 times it couldn't break above that level. You can also see this is resistance. 1, 2, 3, 4, 5, 6. So it dipped a little bit, it came back, it couldn't quite get all the way up there, but there's something about this 122.89 area that it got rejected a few times when it got there. So that is a resistance level. So you can draw multiple resistance levels, you can draw multiple support levels. The ones that I'm picking out to show on here are just some of the easier ones to see so you can understand the concepts to make it really easy for you, and then you can go ahead and add other levels to your chart. So far, are there any questions on anything I've covered up to this point? Dustin, right now you are 100% correct. Tesla does not seem to have any resistance. Although today, I didn't catch the end of the trading day, but there was a bit of a sell-off, I believe. And I think I have a slide on here to show you where you can kind of project where resistance might be for something that doesn't have an upper resistance. So when we have new 52 weeks high and we're in blue sky territory, where do we exit our trade? Where's our target levels? I'm going to show you, I think I have a slide in here because that's a little bit more than just a basic level. So I didn't want to throw too much of that, but I think I do have one slide where I touch upon how we can look at that. How many 1-minute candles should you wait to consider it noise or a proper entry? So it really comes down to the type of trading you do also. So for me personally, I do really short-term trades. So the joke for me and my trading friends is that a long-term hold for me is about 20 minutes. So I've got people that hold stuff for 4 years, 5 years, 10 years. And I might be chatting with one of them. There's one guy that I grew up with, and we ended up trading kind of together. We got in about the same time, and then we don't talk a whole lot. But every now and then we'll get together and we'll do like a 4-hour like hangout where we'll just talk stocks and trading. And so he's like, oh man, I bought this stock like 4 years ago. It's up a good amount. He's like, what kind of long-term trades are you in? And I'm like, oh man, I entered a long-term trade today. It was whatever, Tesla, Shop, Roku, whatever it was. And he's going, how long are you going to be in it? I go, oh, no, I'm already out of it. So the joke for me is that a long-term trade is 15, 20, 30 minutes, maybe 3 hours. I don't like being in trades for 3 hours. I want to get in and get out. So for me, noise on a 1-minute chart is anything where it's just having a tough time getting above that level. It might be 3 or 4 candles. It might be 1 candle. And I'm going to show you an example later where it was 1 candle that got me out of a trade. It was a really quick trade. It didn't make a lot of money, but I saw what I saw and I got out of the trade for 1 candle. And I'm going to show you exactly why. It was based on a resistance level that I had drawn on a chart. If you're in a longer term trade and you're going to hold something for 6 months, you shouldn't even be looking at a 1 minute chart. So whatever noise is on a 1 minute chart doesn't matter whatsoever. So when you're in a trade for a scalp, now a scalp is defined as a really, really, really short-term trade with a large volume. So you might buy 100,000 shares of something, 400,000 shares of something, and you're only looking for 3 or 4 cents on it because the volume that you're doing is going to mean a very small movement will create a large profit. Some of us use the term scalping in a different manner. For us, scalping is basically a really short-term trade where we might be in it for 3 or 4 candles because we see one of those Boeing, those monster Boeing or Amazon candles. In the trade room, we call it a Roman candle, where you just see this thing shoot up. We might see something like that and exit. If we see noise of a single candle after a Roman candle like that, I might exit the trade because I'm assuming that Roman candle is going to be given back. So noise depends on your time frame for the chart. It might be a single candle. If this isn't a 1 minute chart, but if this was a 1 minute chart, I would say this is a bit of noise up here. So the entry for this, if this was a 1 minute chart, would be the break of this level. You can see when it finally breaks, it continues to climb. So would this be noise because we had we wouldn't have drawn the line there. I think I drew this line over in this area, but drawing the line over here, we can see that it was resistance here and here. So where does it become noise? At this point, again, if this was a 1 minute chart, this line I kind of drew in this area, so it wouldn't have been noise over here. Let's do a few examples, because again, when we're doing something live and we're trying to teach something, I can give you the ultimate example. It's a perfect example, and then you go out into the real world and you say, man, I just don't see any of these. How come I'm not seeing these setups? The reason you're not seeing the setups is because they don't always look exactly the same as they're presented to you. So I hate, for one, when I go and learn something and then I go and look at it in the real world and it doesn't really equate the same way. And the reason for that is when you're learning something, you want to be taught as cleanly and clearly as possible. So we're using the best examples, but you might not find the best examples in the real world. So I'm going to show you a few examples for some of these concepts. There's a question on there, what charting service do I use? I use Thinkorswim to do most of my charting. When I'm in trades, it's 100% Thinkorswim. During the day, I've got multiple charts for Thinkorswim set up so that I can see what I want to see, how I want to see it. After hours, if I don't feel like pulling up the Thinkorswim platform, sometimes I'll use TradingView. But what you're looking at here, this type of chart and everything I'm going to show you on this is Thinkorswim. So if you're brand new to trading, having your chart set up the right way is very, very important. And it's very, very confusing because there's so many things that can be on a chart. And if you listen to 100 traders tell you how to trade, they're going to have 100 different things you should look for. Oh, you've got to have VWAP on your chart. You've got to have your moving average. You've got to watch the 200. No, you've got to watch the 50-day. No, you've got to watch the 8-day. No, you've got to watch this. Here's the thing. There's so many different ways to trade the stock market that every one of those 100 traders can be telling you good information. What works for one person might not work for another person. I might be able to use this chart and somehow place a trade that's an awesome trade, and you can use that same chart and not make money. You can show me a trade you made and it's awesome and it was perfect entry and perfect exit, and then you send me that chart and I'm looking at your chart and I can't use it to make money. And the reason for that is we all like what we like. We have to see the information that we process in the way that we process it. So chart setup would be a whole basically different seminar. It could be, a 2 or 3 hour thing depending on your platform. But to answer the quick question, this is going to be Thinkorswim. And I will show you TradingView later on. So this is Zynga. Support, support, support. Support, 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 support. So some of these, when I go over multiple examples, I'm not going to spend 5 minutes talking about it because it's the same example, just a different ticker. I'm showing you different tickers to show you that it's not something I'm making up. It's not magic. It's not once or twice. It happens all over the place. So I'm going to show you a few different examples, but I'm not going to spend 20 minutes talking about each one because it's the same concept. It's just going to be a different ticker and a different form. So Zynga, you can see a clear support level. You can see a clear support level. You can see over here it was kind of resistance, but I didn't draw the line over here. I drew the line when it got to this point. In fact, this candle here is where I drew the line on this one. And you can see this one, it doesn't get all the way down to that exact level. This one, it doesn't get down all the way to that exact level before it bounces, but that area of 550 is important. And then up here, this area on here, it says 603. That's the candle that, whatever candle I chose to drew it on, that was the low. Close enough to round it to $6. So if you're in this trade, this $6 area is what we want to focus on. And you can see it was support here multiple days. It bounced, it dropped, it found support. It climbed, it dropped, it found support. It climbed, it dropped, it found support. So again, you're going to get sick of hearing this because it's that important. If you don't know why $6 is important for this chart on this time frame, does it matter? No. But is there anyone watching this that's going to argue that they shouldn't know that $6 is important? You don't have to know why it's important, but you do have to know that for this chart and this time frame, $6 is meaningful. For whatever reason it is, it's meaningful. So if you're in a trade somewhere down here or even here, you need to know that $6 is an important area. Because if this area breaks, we're probably going to go down and test this 551, which was support down here. So when support breaks, we want to get out of the trade. Because when support breaks, the next support down would be 551. Now you can say there's support here, there's support here, there's support here, here. There are multiple levels of support. But the next major support would be this one where it spent a few days, almost a month, bottoming out at 550. So when this area breaks as support, if you're in a put position or you're shorting the stock, what would my target be? My target would be down here, what was prior support. So that's some of the ways that we use support and resistance to time our entries and to set our targets. Here's DG, Dollar General. We had a massive gap up here. We opened the day down here. This was 829. Let's fast forward all the way here to 113. That level is support. So we gapped up. We gapped up to this level here. We spent a lot of time above chopping. When it drops to that level and it picks up. So again, if you're in this trade, should you know that 151, that area, is an important level? You should. I'm going to make the argument that you should know 151 is an important level. And I'm going to show you in another slide why this point here where the gap started, why is that level important? We want to make that level 141.76. We want to have that level on our chart. And I'm going to show you why that's important as well. So between here and here, there isn't a whole lot of action, right? You see it top out here, we can draw support there. Or in this case, it's resistance. If this level 151 breaks, it was support. If it's no longer support, if we break through that, this 145 area, I would look for that to be the next support. Because over here, it was resistance. So once it breaks through that level to the upside, if we break below this to the downside, this level that it previously couldn't get above is where I'm going to look for it to stop and not get below. If it does get below, this 141 would be my next target. So this is a $154 stock. Right now it closed at 154.50 today. So let's say we're watching it here. If it breaks 151, my first target would be 145. My second target would be 141. So you can see again, we're using the support and resistance levels as targets for what we're looking at this particular trade should potentially do. It doesn't mean it's going to do that. If this for some reason broke below 151, it doesn't have to go to 145. It doesn't have to go to 141. But remember what I said earlier, we're using probability on our side to help determine where it could potentially go. It doesn't have to go there. It could potentially go there. It could also break 151, go down to 149, for whatever reason stop there, and then go make a new all-time high. We don't know. I can't see the future. So when you ask me, hey, DG, I'm in this trade, what do you think? I don't know. What I think is if it goes to the upside, actually real-time support resistance. Look at this. We draw resistance at this candle. Look what it does over here. There's resistance there, resistance there, resistance there. So if you say, what's this going to do? My first response, if we're going to the upside, my first target would be 162. There's resistance in here as well. You can see there's two candles here where it can't get above. It couldn't get above and stay above there. So maybe target 1 is 158, target 2 is 162, target 3 is up here at this all-time high. If we break to the downside, my target 1 is 145 because that was previous resistance. My target 2 is 141.76 because that's the gap. So you can see we're using the support and resistance levels as targets for where we might enter and exit trades. So if you ask what's DG going to do, I don't know. What I do know is that in the past, 145 was resistance, so I'm going to look for that to hold as support. If that breaks, there's a gap here. I'm going to show you why we look at gaps. 141.76 should hold. So my target to the downside is 145 and 141. But since I don't know what DG is going to do, I'm also going to say if we go to the upside, my target 1 would be 162. My target 2 would be 166.98. So I don't know what Dollar General is going to do, but if it goes up, this is what could potentially happen. If it goes down, this is what could potentially happen. So we're using support and resistance to give us these levels of what could potentially happen. Not what's going to happen, because we're not magic. We can't see into the future. Here's ADI. Resistance level right over here. We're hovering around that level here, but look at this. Resistance. Resistance and resistance. Potentially resistance there. It's off by probably just maybe 10 or 20 cents. So we got resistance here. We spent a lot of time getting rejected. We came all the way back up here. We got rejected again. This, I'm going to show you in a little bit, is called a false breakout. And then we got rejected again. We came all the way back. We're going to do it this time. Nope, we got rejected again. So if you're in this trade, ADI, is it important to know that there's something about this 118.50 area? If I'm in this trade and I'm down here, I want to know that 115 or 118.50 is important. On this chart, it's 118.46 because, again, whatever it looks like this candle here is where I drew it. It doesn't have to be an exact level because this candle here, the high was 118.54. So 118.54, this one's 118.46. You have a 10, 15, 20 cent range on some of these where it's going to be resistance or support. You can see it clear enough that resistance, resistance, resistance. So whether it's the exact number or not, we're looking for that area. And if you're in a trade, let's say you're in down here at 105. Let's say you're in at 110. Do you care if it's 118.46 or 118.53? If you know that's an area that has a tough time getting above, whether it's 118.46 or 118.53 doesn't matter. Because if I see it approaching that area and have any kind of pullback or resistance, I'm getting out of the trade because probability says in the past it had a hard time breaking above this level. at some point, you're going to see that it will break above that level. So when I say we're going to watch that level, it doesn't mean it hits this and we're just going to exit the trade. What we're going to do is watch to see what it's doing around that level to see whether or not we need to exit the trade. Any questions so far? We've been going on for over an hour now. This is going to be a little bit of information overload, perhaps. There's a lot to get through, so I'm going to try and speed through some of this. But again, I want you guys to understand the basic concepts of it, why it's important, and how we use it. And I don't want to rush through that in a 12-minute here, example. I want to kind of drill it in that there's a reason why we need to know these levels. And again, if you've been trading for a while, like I said at the beginning, maybe you know some of this stuff. If you're brand new to trading, I want to get it drilled into your head enough why these levels are important, how we come up with them, how we use them, and I don't want to throw that at you in one or two examples. So this is going to be a little bit of a time-consuming event. It's already been an hour and 15 minutes. We're probably, I don't even know if we're halfway through. So again, from this point forward, I'm going to speed up a little bit to get through a bunch of this. On a macro level, short-term trading, what time frame do you... So I look at support and resistance on multiple time frames. I'll start on a 1-year chart, a daily chart for 1 year, which is what this is. So this is 1 year, 1 day. I will start on this and I'll draw my support levels on the daily chart like this. Then I might go into a 3-month chart and see what's going on. Maybe there's new levels in here. So we can draw something there. You see resistance. It broke above but couldn't stay there, so that's resistance here. So I'll do that on this chart. Since my time frames are really short, I am actually going to a 10-day 5-minute chart. And you can see where those levels on the other charts, when you drill into a different time frame, you can see where they specifically hold up. So to actually enter and exit trades, I'm doing support and resistance on this 10-day 5-minute chart. And then I trade on a 1-minute chart because my trades are really short. So I am pulling up the 1-minute chart for today only, and that's where I'm basing my entries and exits on. But you can see the line I drew previously shows up on the different time frames. So I know that this is a support or a resistance level from a different time frame because it was previously drawn on the chart. So when I see it's kind of support here, I'm okay. Kind of support here, I'm okay. Support. When I see it breaks below that and now it's acting as a resistance, if I was in this particular trade, I would want to get out of it unless I'm entering a put position or I'm shorting the stock. Because this level on previous time frames was support. It's breaking through it, so it's showing me that it's not a super strong support, but we have some good upside movement from there. It broke through it again, not too concerned yet. It comes back to test it. It's having a tough time getting above that level now. So now this is where it's a concern. Because it broke through it, but it got back up. It broke through it, but it got back up. It broke through it, but it got back up. It broke through it, now it's having a tough time getting back up. Now this is where this level is a concern for me if I'm in this trade short term. So I'm either going to be in a put position, I'm going to short the stock, or if I'm in a call position, I'm going to close it out. Because now I'm going to see that it's going to have a tough time getting above this particular level. If that makes sense. Let's see if I can jump back to the slides. So, sideways channels. This is an example where we have an upper and a lower level, and we get to this upper level, we drop. There's a lower level here. We get to this upper level, we drop. We get to this upper level, we drop. However, when we drop, we're dropping to the same point on the bottom. So what that's doing is creating a channel for us. We have an upward movement, a downward movement, upward, downward, upward, downward. It's bouncing between these two levels, so we're calling that a sideways channel. If you're in options, you don't want to be in a sideways channel because it's going up, then down, then up, then down. What you're losing in options trading is the time value. So the time decay is going to take away from this trade when all it's doing is bouncing between two different levels. So you're making money, then you're losing, then you're making, then you're losing. The whole time you're losing due to time decay. So if you're in options, you don't want to be in a sideways channel. Now, if the channel is big enough, I'll show you an example there. A sideways channel is a good thing to watch for because you have kind of predetermined levels of where your upper and lower levels of support and resistance are going to be. You can trade between them. But if this is, let's say, $130 and this is $130.80, you don't want to be trading through this kind of whipsaw. You're going to lose money on an options contract. If you're trading stocks, you're making money, then losing, then making, then losing, then making, then losing. So your trade is going nowhere, but in this time frame, you could have been making other trades. So there's a factor of I'm not making money, but I'm not losing it, but I'm also losing the potential to be in another trade that could be making money. So you don't really want to trade in a sideways channel. I will show you the exception to that in a bit. In fact, here's an example of a sideways channel. So you can see we have this massive run up here. Way down here, this is the $450, $460 area. Way up here is $580. So we went on a massive run, and then we just start chopping sideways. So you don't want to be in an options trade here going sideways thinking, well, when it breaks out of this channel, it's going to have a nice run. And it did. It went from 580 to almost 600. There's a $20 move there. That's a nice run. But if you're in a trade here for options, you're losing your time value here over the course of almost a month of just sideways action. So it's better to wait for the break of this resistance to get into that trade rather than get in here knowing it's going to bounce around up and down. So when I said there's an exception, this could be the exception. And the reason for this is the bottom level here, where you're finding all this support, is $570. This upper level is $581. So that's almost a $10 move. It's a little more than $10 if we use the exact levels. If we round it off, it's $10. So if you get something down here and ride it up $10, you can make great money on an options trade. And then if you buy a put and ride it down for $10, you can make great money on an options trade. And then ride up a call, then ride down a put, ride up a call. So if you know there's a channel, you have this movement where you have an indication of this is the upper level here, I'm going to get a put. And I'm going to hold that put until it gets to this lower level, and I'm going to see if this holds as support. And if it holds as support, I'm going to exit my put, I'm going to get a call again and ride it back up to this top channel. We can do that because this is a $10 movement. If this was a $3 movement and you're trying to time the top and the bottom here, and a $3 movement is the maximum movement you have in this channel, it's going to be tough to make money because you're probably not going to time the top and the bottom perfectly. And on top of that, the time decay factor is going to eat up those contract premiums. So we try not to trade when we're in a sideways channel. And a sideways channel is just where we have a solid line at the top and a solid line at the bottom, and we're just bouncing between the two. Here's IWM. This is 144.79. This is 159.50. That's a channel you can trade. So we go from roughly 145 to 160. We didn't go all the way down to the bottom here, but we're back at 160, then we're back down to 145. Back up to 160, 145. 160, 145, 160. So if you know these levels are potential support and resistance, can you make a trade down here at 145 and ride it up to 160? That's an awesome trade. Now, if you can't time tops and bottoms, and here's a big surprise that some people don't want to believe, no one can do that. The people on Wall Street with billions of dollars at their disposal and the best equipment in the world can't time tops and bottoms. I certainly won't from my living room with a $1,000 computer bought from Best Buy. But if it's going between 145 and 160, let's say you catch it in here at 149 and go from 149 and stop it here at 158. Okay, so you didn't capture the whole movement, but you got a pretty good chunk of it. So if the channel is wide enough, we can absolutely trade between that channel. If this happened to be a $3 or $4 channel from top to bottom, those are the ones that you really want to avoid. And the reason for that is you're just going to get chopped around sideways. If it's an options trade especially, you're going to lose premium. Those were examples of static because the levels that we're watching do not change. Dynamic is the opposite. So dynamic is where the dollar value that we're looking at will change, but regardless of what the dollar value is, every time it hits that line, it's support or resistance. So examples of dynamic are going to be trend lines and channels. So I just showed you a sideways channel. In this example, we see an upwards channel. We have moving averages, we have VWAP. So I am going to pull up a very clear example of an upward trend line. This is McDonald's. You can see we have a low here, we have a low here, we have a low here, we have a low, we have a low, we have a low. The dollar amount of this low is 173 something. The dollar amount of this low is about 178. The dollar amount of this low is 194. The dollar amount of this low is about 210. So the actual dollar amount is changing, but what doesn't change is that this particular line, every time it pulls away, it tends to revert back to this line. It pulls away, it tends to revert back to the line. It pulls away, it tends to revert back to this line. So every time it hits this line, it's support because it's bouncing off of that line. It hits it, it bounces. It hits it, it bounces. It hits, it bounces. So this line is a support line, even though the dollar amount that it bounces off of here is 178. The dollar amount it bounces off of here is 195. So the dollar amount that it's bouncing off of is different. But what isn't different is that every time it hits this line, it's bouncing, it's bouncing, it's bouncing. So this is an example of dynamic support, which would be an upward trend line. And dynamic, again, just means that the dollar level is changing, but what isn't changing is that every time it hits that line, it's acting as support. So this is an example of an upward trend line. This is an awesome example of an upward trend channel. So I showed you before we had a sideways channel, right? So the sideways channel is a horizontal line on the top and the bottom. An upwards channel is simply going to be an up and a down level, but the channel itself is moving in an upward direction. So we have a high point and a low point, a high point and a low point, a high, low, high, low, high, low. Every time it hits the high, it reverts to the low. When it hits the low, it goes back to the high. So again, this is an upwards channel because it's just bouncing between these two levels. The levels, dollar amount, are changing each time it bounces, but this particular line is not changing. So we're not drawing this line all over the place. It's one solid line, but every time it hits it, it's at a different level, but it's still acting as resistance. This line, it did break down here for a little bit, but we have 1, 2, 3, 4, 5, 6 times. 7 and 8 if we count these, 9 if we count this one. So every time it hits this bottom line, with this exception, it's bouncing upwards. You want to trade with the trend. If you've heard that term, the trend is your friend. The reason for that is you're trading with other traders, and that's what's going to drive the price higher. So you don't want to fight what everyone else is doing, because your account, whether it's 1,000, 10,000, 100,000, is not going to be able to battle and change the direction of 100,000 traders, each with $1 million in their account, that want this stock to go upwards. So the trend is your friend. This is a clear upward trend. So if you're in a long-term position, let's say you're investing and you want to buy this and hold it for 3 years. If you're buying it somewhere close to this lower level and it gets way up here and gets rejected, you don't care that it's coming back down. It climbs up, you don't care that it's coming back down. It climbs up, you don't care that it's coming back down because you have a longer term hold for this particular trade. There's going to be ups and downs in any time frame, whether it's a single day or a year or 10 years. So for a longer term trade, you don't care about these ups and downs as long as it's staying within this channel, it's moving upwards. It's going to move down, but it's going to move up. It's going to move down, but it's going to move up. So as long as it's in this upwards channel, you're okay with these dips because when it dips, you know where it's going to stop. The point where this does not hold as support, that's where you want to start looking at the trade and should I exit this particular trade. So it bounces, it bounces, it bounces, it bounces. As long as you're in this trade and it keeps bouncing, you don't really have to worry about these dips. What you want to worry about is when it gets to this point and it starts breaking below this and starts breaking down, because then this upwards channel has broken. This is an example of a downward trend line. It's obviously moving down. We have 1, 2, 3, 4, 5 points where it touches this line and gets rejected. So every time it hits this line, it gets rejected. It hits, rejected, hits, rejected, hits, rejected. So this is a downward trend line because it's moving downward. And the trend is that every time it hits, it gets rejected. So there's a downward trend line. Again, the dollar amount that it gets rejected at is up here, 60, 55, 45, 42, 40. So the dollar amount changes, but the line is a solid line. Every time it hits this line, it gets rejected. So we're on an upward swing now. If you're in a call position and you say, what's my target? I'd want to see what it does when it gets to this level here. Whether it's here or here, I don't know. But whatever day it hits this line, I'd want to see what it does around that line, because in the past we have 1, 2, 3, not really that one, but 4 and 5 times where it hit this line and got rejected. So using historical data, when it hits this line, I'm going to watch to see if it gets rejected again. So if I'm in a call position, I want to see what it's going to do around here. And if you're fighting the trend, you don't want to be in a call position because, again, this is a downward momentum stock. It's moving downwards, which means the sellers are in control. People are not willing to step in and buy this particular ticker. That's not necessarily something you want to buy when everyone else wants to sell. Adobe, we have a downward channel. We have an upward level where it keeps getting rejected. We have a downward level where it keeps finding support, but the overall trend is down. So if you're in a put position, you're happy, you're not so happy. You're happy, you're not so happy. You're happy, you're not so happy. As long as this continues to be the downward movement, you're okay in that position. It's going to bounce, but you're expecting it to bounce downside even further. So as long as it keeps making these lower lows, you're in a confirmed downtrend. So this is a downward channel, and as long as it stays in this channel, you're good with your put position. You can see when it breaks that channel, you want to get out of that position. When it broke, this was around 275, it's now 354. So when we say support and resistance, when they break, get out of the trade, don't hope it goes back to the pattern it was in. If it was here at 275 and now it's 291 and you're hoping it gets back into this channel, it never got back into that channel. So you're hoping, and at some point you're going to cut this for a major loss. As long as it's in this downward channel, you're okay with the pops to the upside. When it breaks that downward channel, it's time to get out of that trade. I'm going to jump back over to the comment section. Are there any comments so far? Let me see if I've missed anything. Is it possible to show when? I will do some specific tickers at the very end because this is going to be a decently long seminar. So if anyone sticks around afterwards, I'll do specific tickers for you guys. So I can show you when. Let's save that for the end. Cup and handle formation, there are patterns that we're looking for. I will show you some of that in a bit as well. Does TOS have price alarms for trends in a similar way? I don't know if they have alerts for trends. If they do, I've never used them. You can set an alert for a moving average. So if it bounces off, what you can do is set up a scan, and it can scan for anything, say, bouncing off the 34 exponential moving average. And you can have the scan off to your side, and anything that pops up on that scan would have just bounced off the 34 moving average. So you can do stuff that way. I don't know if you can do an actual alert off of that. And if you can, like I said, I don't use it, but I do use some watch lists based on certain types of, not necessarily patterns, but support and resistance. So you can do that, and you can have that on a watch list, and as soon as it pops up on the watch list, you can click it, it pulls it into the chart, and you can see what the pattern was from there. Moving averages. So this is an example. This line, this squiggly line here, is a moving average. And you can see here, when it touches that moving average, it bounces and goes upwards. When it rolls over, that moving average that was support this whole way up is now acting as resistance. So moving average is a form of support and resistance, but it's going to change the actual dollar value every time it hits. So when it hits it here, it's a different level than when it hits it here. When it's here, it's a different level than when it hits here, which is a different level, but whatever level it happens to be, when it gets to that line, it bounces off as support. Once it rolls over, it might be a little hard to see, but this point right here is resistance, this is resistance, and this is resistance. So once it rolls over, the dollar amount that becomes resistance changes, but what doesn't change is whatever dollar amount that line happens to be is now acting as resistance. So we're riding it up as support, we see it rolling over, and now it's acting as resistance multiple times. Here's a perfect example of the 200-day moving average. This is CMG. This is a daily chart, so this is 1 year of activity for CMG. We're way above the 200. When we have a pullback, look where it stops. It stops right at the 200-day moving average. And the 200-day moving average is a major moving average that people watch. Algorithms watch it. It's an important level that some traders will not trade any stock if it's below the 200-day moving average. So the 200 is an important moving average to watch. If you look at CMG, we're way above it, way above it, way above it. When it pulls back, it stops immediately at the 200-day moving average and it bounces forward. So moving averages are important to watch, whether it's the 200, the 50, the 8, 31, 55, 89, 21. There's so many of them. You just have to see which one this particular ticker is respecting at the time and pull that up. Let me see if I'm going to change. This was today's action for BA. So if you look here, this is the 34 exponential moving average. This is one of the favorites that I use. A lot of us at Blackbox use the 34. Rejection, it bounces, rejection, it bounces, rejection, it bounces, rejection. Support. And then as the 34 is moving up, BA is following it as support on the way up. So when you have a particular moving average that the ticker respects 1, 2, 3, 4, 5 times throughout the day, if you're short BA, you're not worried about these pops as long as this 34 still holds. You're short, it pops, you're not worried about it. You're short, it pops, you're not worried about it. You're short, it pops, you're not worried about it. you're short. It pops and now it's above the 34, and you can see magically from the rest of this day forward, it does have some ups and downs, but from the rest of this day forward, it's never below this level. So as long as you're below the 34 exponential moving average for today, for Boeing, you don't care about any of these pops because it gets rejected every time. When it doesn't get rejected anymore, that's when you want to start looking at, okay, this trade might be done. If you're in a really long-term trade, a 1-minute chart does not matter to you. Like I said, I do short-term trading, which is why I noticed the 34 in Boeing today. So since I do short-term trading, the 34 is up on my chart. I see it getting rejected. I'm not scared of any kind of a pop as long as it's below the 34. When it finally breaks above the 34, now I've got to start telling myself the trend is changing. And the trend is that it gets rejected at the 34 exponential moving average, and now it's not anymore. So now that it's not when it previously was, that's telling me something's different. Since something is different, that's my indication to maybe get out of this trade. If you don't, you get a pop, it moves against you, and then it starts going in your direction again. You think you're okay, it's below the 34, but it can't make a lower low. This could be looked at as a 1-minute bull flag if you know your patterns. And then when it breaks out huge. So again, the trend is below the 34. Once it breaks above the 34, what that's telling me is that the trend is changing. And once the trend is changing, that's an indication that I'm going to look at my trade to see if I want to close out my trade. Or maybe I want to take the opposite position. So maybe at this point I want to take a call position. If you take a call position, you can see it climbs and then it gives that back, but it gives it back to the point where the trend was broken. So you're not losing money yet because you got in at this point and it pulled back to that point. You'd lose a little bit from options because of time decay, but then it pulls back upwards. So once this trend is broken, I'm either going to exit my trade or I'm going to flip to the other side. So this is the 34 exponential moving average. You can see the level that it changes, or the level that it hits and gets rejected changes, but it doesn't matter what level it is. Anytime it hits whatever level it is, it gets rejected. The point where it doesn't is when the trend is changing. So that is a moving average. VWAP is another one. VWAP is a form of support and resistance. On this particular ticker, you can see we're climbing. We have a nice pullback. This yellow line here is the VWAP for this particular day, and it bounced. Once we broke through that level, I'm going to introduce this concept. Prior support becomes resistance. So once we break through this level, VWAP is now acting as resistance. So we're on an upswing. When it pulls back to VWAP. If you guys don't know what VWAP is, it's an indicator for another time. I'm not going to get into what the actual indicators are. It's basically volume weighted average price. So it's something that we typically watch on a shorter time frame because it's telling us where the volume occurs at what price. So the average up here, this is the average of where people own this. As we get a nice spike, when it pulls back, people don't want to let it get below this level because that's the average of where they own it at. So they're going to buy more of it and prop the price upwards. When it breaks below it, that means the buyers don't have the strength to keep it up here anymore. So when the buyers don't have the strength to keep it up, it drops. But they don't want to see it drop too much, so they step in and buy more of it. But when it gets to this resistance levels, the sellers take over and say, nope, we're not letting it go any higher. We're going to drop it again. So the sellers step in, people take their profits, and the price is going to drop. So VWAP is another form of support and resistance. I like this example because it's perfect support and it becomes resistance. So you can see that the levels of this yellow line are changing, but when it hits this level, whatever dollar amount it is, it's acting as support or resistance. So VWAP is a form of dynamic support and resistance. All right, so how do we draw all this stuff? Before we go any further, I'm going to switch screens one more time back to the questions. One of the questions is, how exactly do you draw the lines? Perfect timing. Do you day trade based off of 34 EMA? The 34 EMA is one of the things I do use for my day trades. Day trading and scalping, I use the 34. I don't use the ATR trailing stop indicator. So for me personally, I don't like anything on my charts. So I use support and resistance that I draw in. I use the 34 exponential moving average, and that's pretty much it. Sometimes I will put VWAP up on the chart, but I don't like a lot of stuff on my chart, and I'm going to show you a slide of why that gets confusing and why that's bad. Does anyone want to take a bit of a break? I do have a bunch of examples coming up. This has been almost 2 hours, so I want to make sure you guys are awake, because this point on is how do we draw and how do we use support and resistance. So I hope you guys understand that it's important to understand and how it's important and why it's important. Now I want to get into how do we actually draw it and how do we use it. Because now that we understand what it is and that it works, that's great. But how do we do it? That's what's coming up. So if you guys want, type in the chat section if you want a quick 2-minute break to grab some water, if you want to get up, stretch your legs, because this part coming up is how do we actually use the information. I've shown you now that you should be a believer that it works. So now that you're a believer that it works, great. How do we use it? There's one comment for grab some coffee. So go ahead, everyone take a quick break. Make it a minute, make it 2 minutes. There's a lot to get through, and like I said, I'm kind of trying to speed it up from this point forward, because now that you understand what it's all about, I want to show you the nitty-gritty. It's not going to be an in-depth seminar of every little piece and nuance of it. So everyone go grab some water. If you don't want to get up, use this opportunity to ask some questions in that chat box. I'm going to pause it here, so if you do want to grab some water or coffee, please make it quick. Make it a minute, 2 minutes, whatever it is, and then come back. And for those of you who do want a break, for those of you who don't, go ahead and type some questions in that chat room there. Any questions on what we've covered so far? If it's a question on something I'm going to cover, I'll hold off on answering it. Who asked about when earlier? I don't know what time frame you were looking at as far as when. So what I do is I start on a 1-year time frame. You can see with when there is clear resistance in here. You can see it was resistance over here. It was building up under resistance, and then when it punched through, we had a nice punch through. We had a gap down, a big gap down there. So on a shorter time frame, so this is, I left the 34 exponential moving average on the chart. So you can see as long as the 34 exponential is moving upwards, we're in an uptrend. It starts leveling off, and then we get a gap up, it's moving up. When you see it start curling over, you can see the 34 roll over right here. That's an indication that you want to get out of a long position, because look what magically happens. Once it rolls over, it's now resistance, 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 and it did break above it there before a gap down, but you can see it's on a nice uptrend. Once that 34 rolls over, it's now acting as resistance. So what time frame were you looking for when, or were you just looking for what we can think about future-wise? So I use support and resistance on the daily chart for 1 year. I'll actually show you, let's go through. So this is a daily chart. This is a 1 year chart. So if this was a trade I was looking to take, I would have my resistance level drawn here. I would have a resistance level drawn there. There's probably a decent resistance level in here. So that's the start of my drawing. It's on a daily chart. Then I'm going to drill down to maybe, see, on this one I don't trade too much, so I don't know what time frame I would look at. So I would probably go to this one, and those levels that I drew are the major levels. I would drill down a little further to see if there's anything more that we need to add on a shorter time frame, and I might add one there because you can see support, support. So as we're dropping down, my first target for the lower level might be there. And then after that, we can see resistance, resistance before a gap. So my next target would be down there. And then if I'm actually placing the trade, I would go to the 1 minute chart. And those levels that I drew previously, I would watch to see what it does. So if I'm in a short position, this would be maybe, I forget where, this was maybe target 1. When it breaks below that, target 2 would be wherever further down it is. It didn't quite get there yet, but as long as it's below that line, okay, target 1 would have been this one here. So I start on the daily chart for a year, and then I drill down to typically 10-day, 5-minute chart. And then I draw on the 1 minute chart for today, the support and resistance for today. And that's what I'm basing the trades on, is the 1 minute today chart. With stocks at all-time high, where do you find a safe time to exit? I have 2 slides that will cover that, kind of. The support and resistance on the day might not get hit intraday. Yes. Because if you think about it, the support and resistance on a daily time frame is going to be a little bit of a wider time frame than a 1 day chart. So support and resistance for win, right now this is 133, 137, 141, 145. So these are about $4 between each level. If win typically doesn't move $4 in a single day, let's say, I don't know what it is on this one, but let's say the average movement for win is $1.70. You're not going to get between these 2 levels on a particular day when these are $4 apart on a daily time frame, but the average single day movement is $1.70. So you're not going to get these levels. So that's why I go to the 10-day, 5-minute, because this is telling me what happened in the last 2 weeks. So within the last 2 weeks, I know that there's a level to watch somewhere between here and here. There's some consolidation in there. I know that it's topping out over here. So I'll use the shorter time frame. There's some resistance here, and I'm just throwing these up because I'm not actually in a trade. I'm not really paying attention, but I'll use this 10-day, 5-minute chart to give me the time frame for the most recent action. Because these wider actions on a 1-day chart, like you said, they might not hit on an intraday chart. You're in a 140 put for this week. So let's actually erase all these lines and see. So, well, we can see there's clear resistance over here, which was support here. So if we get a massive move downwards, 135, that's about a $5 move down. This 34 is at 138.23. So we have about a $2 movement to that level. And if we draw a line where these candles are showing support, that matches with the 34 exponential. So my first target to the downside would be 138.02, which is another about $2 down from here. So that's a real quick, real-time how I would look at this chart for support and resistance. A trend is defined as 3 lines or more, and I do have a slide that shows you that. Who wanted coffee? Colonel Kane, are you back with us? We'll give Colonel Kane a minute or so more. So we're coming up on 2 hours. I know this is going to be one of the longer presentations I've done, so if you guys want to bail or have other things to do, I will not be offended. I understand this is a very time commitment type of thing. Scuba, I don't limit trading really to anything. If something's moving, I'm going to try and trade it. If it's something I typically trade, I'm going to watch it every day. If we get options flow on something I've never traded before, I might trade that anyway based on the options flow. My main screen is 9 tickers, SPY and 8 others. So every day I'm watching the same 8 tickers plus the SPY. But then I have another screen. I said before I have multiple monitors. So on another screen, I have a different setup where I can basically pull up any ticker whatsoever. So if something's in the news, I can pull that up and look at it. But my main screen is going to show the SPY and the same 8 tickers. So those are the ones that I watch every day. But I don't limit my trading to those 8. The 34 will show the trends quite a bit. You can see on this chart it's kind of hard because with all this gapping and big movement, the 34 is moving upwards. So we're in an uptrend, but 2 of these days are monster moves. When it rolls over here, we're in a downtrend. When it rolls over here, we're in an uptrend. It rolls over, we're in a downtrend. So you can see that the 34 does, and this wasn't a ticker that I really had a lot of information on. So kind of being a random ticker that I just chose, you can see that the 34, if it's moving upwards, we're in an uptrend. If it's moving downwards, we're in a downtrend. Those points where it's going sideways and changing, you can see we've already missed from 103 to 120. So the 34 is changing here. We've already missed a $17 move, but it's changing from 120, it goes up to 141. So there's another 20. When it rolls over here, we missed the move from 140 to 131. So we missed a $10 drop before the 34 rolls over. This is a little different because of these big gaps in here. If we take so this is Apple. So without the big gaps, you can see that we have support at the 34. We broke it, so we're on a downtrend. When we break above it, we're on an uptrend again. We have support. We did break through it here, but the 34 didn't roll over. So if you're in a short position here, you're in it for a pretty short time because then the 34 starts curling up again. And then you can see support, support, support. So the 34 really does act as support and resistance, showing you the direction of the trend. Colonel Kane, are you back yet? If not, we're going to move on anyway, but I will give you a second if you're near the computer going, hold on, hold on, hold on. Jenny, you are welcome. Brandon, the China outbreak, there are things like that where you just can't predict what's going to happen with that. There's no way to know a plane is going to fall out of the sky. There's no way to know a country is going to have a disease outbreak. There's no way to know certain things that go on in the world that are going to affect what's going on in the stock market. So what we do want to do is have, like I said before, I can't tell you if something's going to go up or down. What I can tell you is if it goes up, here's what I'm looking for. If it goes down, here's what I'm looking for. So I can't tell you that a plane is going to fall out of the sky or a disease is going to have a massive outbreak. But what I can tell you is that if I'm in a call position and we get news like that, I'm going to exit the call position and I'm going to have an idea of where things might bottom out. So if I'm in something at $70 and there's a massive support line at $68 and we get bad news, I might not sell that position. I'm going to let it go down to 68 and see if that holds as support. If it does, then I have no reason to exit the trade. If that level breaks and the next level down of support is maybe $13 lower, then I'm going to say, oh crap, I'm going to get out of this position. So we can't foresee a disease outbreak, a plane falling out of the sky. a company going bankrupt that was fraudulent. They were hiding information. We can't see this stuff. So what we can do is we can have a level of upside and a level of downside that we're watching for. And when things move to the upside, we have an indication of where we might top out. We have an indication to the downside of where it might bottom out. So support and resistance can't predict what's going on, but it can predict where we might stop the downward bleeding or the upward momentum. Yeah, wind did get hit a little bit because of that. Or probably a lot because of that. Okay, Colonel Kane, if you're back, great. If not, we are going to move on a little bit here. So, if you guys type questions, I'm not going to see them for a minute because I am going to change back to the other screen. So I will get back to you guys on the questions, but for now, I'm going to jump back to the other screen so I can't see your questions at the moment. How do we draw support and resistance? The first thing we want to do is connect 3 points. And the reason for that is, let's say it's a Tuesday afternoon and you see me at the pizza shop. No big deal, right? I'm just getting lunch on a Tuesday. Next Tuesday, you see me at that same pizza joint and I'm eating pizza again. Is that really a trend? Are you going to say maybe this guy eats pizza every Tuesday? I was there 2 weeks on a Tuesday. Maybe it's just coincidence. Maybe I was in the area picking up dry cleaning on Tuesday. Who knows? If you see me next Tuesday at that same pizza joint at that same time eating lunch, now are you going to start to think, okay, there's something going on where this guy's just in the area on Tuesday and he likes pizza, right? So if you see me at the pizza joint twice, that's not really alarming. It's not really saying, there's something weird about this guy on Tuesdays, he likes pizza. If you see me 3 or 4 times at that same pizza joint every Tuesday at 3:15, you're probably thinking, okay, maybe he gets off work at 3 and 3:15 he's eating pizza every Tuesday and he works around here, whatever the case is. There's a trend that's building. If you see me there on Tuesday and next Tuesday, it's not necessarily a trend. It could be the start of a trend, but it's not really a trend. Now, if you see me there 4 Tuesdays in a row, now you're starting to think, okay, this guy eats pizza on Tuesday. That's his thing. So 3 or more points is going to be a trend. Less than 3 points, it could be a coincidence. It could be the start of a trend, but we want 3 points to really confirm the trend. Now, I am going to go back to McDonald's. So the reason I like this one is because this is a very clear and obvious uptrend. Okay? No one's going to argue this is a nice, solid uptrend. So this is a really easy one to use as an example of how to draw support and resistance. We want 3 points. 1, 2, 3, 4. These don't actually touch it, but they're close. What we do have is a point here and a point here. And I think when I drew the line, those are the 2 points I used to create it. So I'm going to choose trend line from Thinkorswim. It's going to look different depending on your platform. But I'm going to go to the low point here, and I'm going to draw the first point. And I'm going to connect the low point of this particular candle, and I'm going to draw my line. Magically, it's not exactly, but it's really close. Support there, support there, support here. So that's a pretty good trend line. The problem is, it's only really touching 2 points. You can see that it's a clear trend line, but it's really only touching 2 points. Now, this is a pretty good trend. If you drew this trend line, no one's going to yell at you and say, you don't know what you're doing, man. That's not a good trend line. That's an awesome trend line. But we can make it better. We can make it better by connecting as many points as possible. So what I'm going to do, if you have Thinkorswim, this is one way to do it. I'm going to activate the drawing, and I'm going to move it a little bit upwards to there. Now you can see the candle here, it breaks below that trend line, but it does close above it. But if I change the line, it's no longer touching the trend line. It does break below it. But why did I move it? We're still close here. We have an exact point there. We now have an exact point there, an exact point there, an exact point there, and a closer point on these. So you want 3 points of contact, and you want it to touch as many points on that line as possible. So if you drew that first line a little bit further down, that's a good trend line. If you move it this little bit up, it's even better. Now the difference between these two lines is so minimal that no one's going to argue if you drew that trend line. If you look at how close those two are, the difference on any given trading day, in fact, let's look at this particular one. The difference here is 195.32, and the difference here is 194.82. So we're looking at any given point, a 30, 40, 50 cent difference. On a ticker that's $200, 30 or 40 cents isn't really going to impact us. So sometimes when I say it's at a support line, it's a specific dollar amount. But oftentimes, and I'll show you that it's going to be a zone as well, it's not an exact amount, it's a zone. So we have a 30, 40 cent buffer on a $200 stock. So if you drew either one of these lines, it's fine. The problem comes in when they're not so close together. So if this first line, this is not the trend line, but let's say there was 1 point down here and 1 point up here that connected. And let's say there's even a third point up here. We can use that as a trend line, but the stronger line is going to be when you can connect 1, 2, 3, 4, 5, 6, 7 points. So what we would want to do is connect as many points as possible. So draw your line between your 3 points, and then if you can move it a little bit up or down, find the point where it touches as many specific points as possible. And again, we have 1, 2, 3, 4, 5, 6, 7, and these are close. So this is going to be the better trend line than if you use the absolute bottom of this candle and this candle. That's how you draw an upward or downward trend line. If you want downward, we have a high point here. And we have a high point here, and you can see it's also here, it's also here, it's also here. So that's not the exact line I wanted to draw because my chart platform has a delay when I start recording things, but that's the actual line. So we have a point here, a point here, and a point here. And perfect example, right? So if we activate it, the line that I ended up drawing by mistake is actually a little more accurate because now it touches up here 1, 2, 3, 4, 5, 6, 7, 8 candles. So how easy is that to draw a trend line? Is anyone confused so far? Because that should be pretty clear as far as how to do it. You want 3 points or more. You can have as many as you want, but you want 3. 2 is possibly a coincidence. 3 is a trend. And then you want to adjust it to make sure you're touching as many points as possible. Does that make sense to everyone? Is that pretty clear, pretty easy to follow? No comments on that, so I'm going to assume it's as clear as day. So 3 points, and then you want to adjust it to make sure it touches as many points as possible. So whether you're going up or down, if you want, so let's do this actually. Let's draw a channel. You can draw your up and down point, and you can drag that to your upper point. It doesn't really touch here, but it touches 1, 2, 3, 4 candles there. It touches 1, 2, 3, 4, 5, 6, 7 candles there. So if you want to draw a channel, same thing. Pick your points, pick your upper point, and adjust your upper point so that it touches as many points as possible. So you can see it doesn't quite get to the upper channel here, but it does here. So this is where I chose to draw my line, and then we see it touches all up in here. So this is going to be the more accurate line than if I drew the upper channel over here. And we can get as messy as you want to get with lines. We can draw, there's obviously a high point there, so we can put a line at the high of day there. You can see that it was resistance over here as well. There's one candle here where it's resistance. There's a candle here where it broke above, but it's kind of resistance. So that's not a super strong line right there. I would draw that line just because it was today's high, which is the highest point it's been in recent times. So we spent all this time away from there. It got to that point and got rejected. So I'm going to put a line there just to see that that's the point where it had the maximum amount of climb and then just got rejected. So if we move up again tomorrow, I'd want to see what it does around 213.66, which was today's high, and I want to see it punch above that. And then where would my first target be? Look at the high point of these two candles, which is also support for this candle. So 215.67 would be my first target if it breaks above 213.66. And where do we go above that? There's a whole bunch of mess in here, so this 220 area would be my next area. Whether it goes from 215 to 220, probably not. It might go up, down, up until it gets there. It might go up, down, and then straight there. But that's how I would use support and resistance. And you can see how it gets messy if you leave too many lines on your chart. And I'm going to go over that in a bit as well. But like I said, I do want to run through a lot of this because I've got a bunch of examples I want to show you. And at this point, it's over 2 hours. So again, I'm not going to spend a whole lot of time on each individual chart from here. So before I move on though, is it really clear how to draw? 3 points and then adjust it to touch as many points as possible. Is that easy enough for everyone? Chrissy, what is the shortcut to draw the draw line? So for me, I have Thinkorswim set up so that the most common things I use are automatically up here. So like I can draw any kind of a line in here. And then the next common thing I use is a trend line, so I can draw these random lines in here. And you can see that I'm just drawing random lines. These don't make any sense whatsoever, but when you start drawing, and then you go, oh crap, I can't pay attention, what's going on? I've got one set up, that one button will remove everything. And since I'm recording, it's really slowing my system down. It's actually not removing them. But when I click on this button here, it will actually remove every single thing I just drew in one line. Was anyone else having problems with Thinkorswim today? Because all of these charts that I have, that I'm showing you guys, I actually had to redo them this morning. Because the time frames that I had set up on them, every single one of them was actually not set up the way I had it set up. So when I'm drawing these lines now, it looks like these that I have set up. Like when I click no studies, it automatically erases every line I just drew, and it didn't do that. So Thinkorswim is actually messing up for me right now, which is a really bad time to do a demonstration of how to draw stuff, but we're gonna take it as it is. So I see some of you guys had problems as well. So this is a 5-minute chart for Citibank for December 26 to 1/9. There's a few things I want to show you on this chart and on time frames. So on this chart, this is a 5-minute chart. We have resistance here, so I draw a line. We have some resistance here. Didn't quite get up there, almost resistance. So that's a 5-minute chart. When I zoom out to the 1 day, we see how it was resistance up there. Now I'm going to zoom out further to the week. And if we go way back here, you can see I drew the line over here, but this is way back here in January of 2018. You can see how that same line is resistance. So I drew the line over here, and that same line that I drew here a year ago was the same spot that Citibank was having trouble getting above. So a year ago in January, it could not get above this level. Fast forward a year, we're still having trouble getting above that level. So is Citibank something you want to watch at this $80.50 level? Clearly, because it couldn't get above it here, and I didn't even know about this until I pulled out to the weekly chart, but having trouble over here on that day, you can see why it's having trouble, because previously it couldn't get above that. Let's go further. I have a 10-year chart set up. So is Citibank looking really good to you guys? This is a 10-year chart. We're on a nice upswing over the last 10 years, right? One thing I want to point out to you, and someone asked this before, is what time frame do you draw your support and resistance on? It has to match your trade, and I'm going to get into that in a little bit. But one thing I want to point out is your time frame will impact what you're seeing. So if you look at Citi, this is a 10-year chart. This is a monthly chart. So every candle is showing an entire month of activity. This is a 10-year chart. We started within the last 10 years, we were down at $21.40. We're now up at $80. So that's a pretty good upswing, right? If you change your perspective, you're going to change your outlook. Let's go to a 20-year chart. Is Citibank doing good now? See, so if you change your time frame, it changes your perspective. If we go to a weekly chart, we're at a high point here. So we want to see a break above this with volume for a good upside swing. If you go to a monthly chart, you go, wow, we're on a pretty good upswing. Okay, so we got to this point here. We pulled back. That's a healthy pullback, and now we're climbing again. I want to see it get above this level here. Good, we're looking great. Citibank's doing awesome. If you pull back to the 20-year chart, you realize over the course of 20 years, Citibank isn't doing as good as you thought it was if you looked at a 10-year chart. So changing your time frame will change your perspective of what you're looking at. So you don't want to look at a 1-minute chart if your time frame for your trade is 6 months to a year out. Because whether it drops today or not doesn't matter. Because you're looking for a 6-month to a 1-year trade, what it does today doesn't impact what it's going to do 6 months to a year from now. So I'm going to get into a slide for this also, but match your time frame for the trade to the time frame for your chart. So, do you guys remember what happened here? Why would Citibank go from $550 to $100? If you can see the time frame on the chart, that is the financial crisis of, 2007, 2008. And there's probably, I don't want to say probably, there's potentially some splits in there. I think Citibank has had some splits over the years. I don't know how that has impacted this, but this is the 2007, 2008 financial crisis. Look what happened to Citibank. So again, and this isn't important as far as trading off of, I just wanted to point out that if you change your time frame on the chart, it will change your perspective of what you're looking at. Colonel Kane, is that something we should really pay attention to? Let me read the rest of that because that's going to change my answer. The fact that a lot of tickers, markets around the world are trying to break out or break down from long-term resistance support. Yes. So when you have a really long-term support that's been holding, and now all of a sudden it's not, and you have that for a lot of tickers, that's kind of giving you an indication that the general, it's not just a specific industry or a specific company, the general feel is that there's a lot of things going on right now that are all kind of matching. So when you hear a lot of people right now saying the sky is falling, get puts on everything, sell, 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 everyone's thinking there's a pullback coming. And there is, but no one knows when. No one. These guys with billions of dollars of equipment and capital at their disposal, they don't know when the top is coming. In fact, people have been calling for a recession and a pullback for years now, especially for the last year. We've run so hot, it can't be hot forever, it's going to pull back. Everyone who's been shorting SPY for the last year has been losing money. So I don't want to say the sky is falling, I don't want to say short everything, but when you see everything at an all-time high and everything at the same time starts pulling back, it's something to look at. It's not going to freak me out because it's not telling me anything yet, but it's telling me something to look at. If I'm swing trading, do I use the daily chart? Yes. If I'm swing trading, my initial trade is going to be off of this 1-year daily chart. So again, the point of Citibank was just to point out that if you change your time frame, it'll change your perspective. Oh, look at that. I wasn't even paying attention to my own slide. Match your time frames. So if you're in a trade for 6 months out, support and resistance on a 1-minute chart don't matter. If you're in a trade for 6 months out and you see some weekly options flow going against your position, not necessarily going to impact your trade. Because someone's placing a trade in the weekly options for this week, you're placing your trade for 6 months out. So match your time frame to your trade. If something's dropping today and you're in, let's say you're in commons, or you have a call position for a year out, 6 months out, 4 months out, and the stock is dropping today, it doesn't necessarily matter to you because you're not worried about a 1-day drop. You have 6 months out of time for your trade. So match your time frame and your chart and your support resistance to the time frame of your trade. Okay. So I told you before, we have specific lines that we look at. We also use zones. And when I said before on, I think it was McDonald's, it's a $200-something stock, we're not worried about a 10, 20 cent movement. So instead of a specific line, it might be a zone. So this is hard to see, but I have a shaded area here. The wicks are entering this shaded area. It doesn't quite get above the top level. So this is a zone of resistance. It's not a specific line, it's a zone because it breaks this bottom line, but it can't break the top. So even though it broke above this bottom line here, we don't want to say we're cleared above resistance because this zone here is telling us that it broke this bottom line, but it needs movement to this top line to see if it's going to get rejected. And I think I have OKTA. So you can see here, this was support for this candle here, 118.27. This candle here was support. If we saw this candle break above that and say, ooh, look at that, we broke above support, we would have been stopped out of a trade, or it would have been a losing trade, because it got to this level of 119.46 and it got rejected. So even though this level was support over here and we're looking for it to be resistance here, we needed a zone for that resistance. It wasn't this exact line. It was a zone between 118.27 and 119.46. So this candle here, support was 119.46. But this candle, it dropped to 118.27. So if you entered a short position here, or you bought some puts because it broke this 119.46, you would have been out of that position with a loss because it immediately hit this 118.27 and bounced. So we draw a line at 118.27. We draw the line at this candle low, which is 119.46, because that was the support that day. This was the support this day, but it didn't break down, it went back up. So I'm going to use that as a zone, and we can see over here, when it enters that zone, it doesn't mean it cleared resistance. Because it did clear that bottom line, but it hit the top line and got rejected. So it's not a line that we're looking for. It's a zone between 118.27 and 119.46. So when it's between, so instead of looking at this bottom line, which was support over here to become resistance, and saying, oop, it cleared resistance, I'm going to go long, there was support here, which created a zone. And as long as it's in that zone, it's causing some confusion. I'm going to wait and see what it does to the upside or downside before I take a position. You can see here a few candle bodies and a few candle wicks were in that zone, but it wasn't going to the upside or the downside until it broke out of that zone, and now we're clear to the downside. Looks like it's starting to move back up, but while it was in this zone, it's not safe to say we're in support, I'm going to go long, or we're breaking resist, or we're breaking support, I'm going to go short. Because in this zone, remember over here, it's just confusion. It's congestion. We don't know what's going on. So when it's in this area here, I'm not going to say we're at support, I'm going to buy calls. I'm not also going to say it's breaking this level of support, I'm going to buy puts. Because while it's in this zone, it's just congestion. It's confusion. We don't have a clear direction. Once it broke out and opened below that zone, now we're going to stay below that zone until we can get either back in it or above it with volume. But since we're below it, just like over here, I would look for that to be resistance if we come and test it. Today we tested it pretty close. We didn't get all the way up there. And then it got pushed back down. So for this particular ticker, I would be looking for this area to hold as resistance, just as it did over here, until volume comes in to bring it firmly above that area. So support 101 is we have lines that we draw. We're going to take that to the next level. 102 is that it's not an exact line, it's an actual zone. The next one, whole numbers. Whole numbers act as support and resistance just because they're nice, clean, whole numbers. $200, $150, even if it's $180.50. $13.50. $219. So when we have these clean whole numbers, sometimes those act as resistance or support, depending on what direction it's going in. So here's Microsoft. This was, I actually changed this at some point for some reason. We're going to make that $130 even. Resistance, resistance. It took volume to break through. $145. You can see it's consolidating under 145. It hit it, it dropped. It hit it, it dropped. It hit it, it dropped. Hit it, dropped. Hit it, dropped. It took volume to break through 145. If we zoom in there, look at all this action under 145. That was acting as resistance. Resistance, 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 resistance. It tried to get there. It couldn't. So 145 is a whole number that was acting as resistance until it broke through with volume, and then it made its move upwards. So sometimes, let me see if there's another one in here. Not necessarily, not as clean as an example as I would like, but sometimes whole numbers are going to act as support or resistance. So if you're in clear skies, like some of the stuff we're in now is at all times high. Let's say a stock is at 127 and it's never been here before. What's the next resistance? You can potentially look at $130 as resistance, just because it's a nice clean whole number. Depending on how much that ticker moves. If it moves 40 cents a day, your next whole number would be 128. If it moves $1.50 to $3 a day, your next whole number, make it 130 and watch what it does around there. So whole numbers can act as support and resistance. Support becomes resistance. This is a very key factor of technical analysis. If you look here, we have support, support, support. Once we broke down through that, that same line is now acting as resistance. Support becomes resistance. Resistance can become support. So it's important to leave these levels on our chart because we have support, support, and a massive gap down for Biogen. When we have a massive gap up, look where it's stopping. It's stopping right where it previously held as support. It's now resistance. So it tried. It can't get above this level that it previously couldn't get below. So support becomes resistance. And I like this chart because this is a ridiculous chart to show the example because of these huge gaps. But even with a huge monster gap, this went from 320 down to 230. Support, support. When it had a monster gap up, where did it stop? The same level that it couldn't previously get below, it now can't get above. So the concept is called support becomes resistance. It can be the other way around as well. Resistance can become support. So if we had a tough time breaking through here, then we finally did, like let's say over here we break above this, If we start dropping, I would look for this 30 or 305.90, 306 area to become support. So just like support became resistance, once we break through any downward movement, I would look for this previous resistance to now become support. CVX, Chevron, this candle here, support. Once we broke through, it became resistance, So support became resistance. Important to understand that, because if you're in this trade here, and you're in this trade here, once we break through that level, if there's any downside movement, we would be looking for it to hold this level. Or if we're in a trade down here, since we know previous support could potentially become resistance, as it gets towards this area, we want to watch and see what it does. And in this case, perfect example, it got rejected. Tried it again, got rejected again. So support becomes resistance. It's important to know that, because if we're in a trade in one direction or another, we're going to look at prior support and resistance to flip and be current support or resistance. This one, I either did not draw the line ahead of time or Thinkorswim messed up my charts and I forgot about it, but let's go ahead and draw resistance, now support. And this is a real world example. So this is one of the things I like to show, is because it's not a perfect example. We had resistance here, resistance. It's support here, but it wasn't perfect support. This level is $30.14. Rounded off, let's call it $30. Over here, well, we can't call it 30 because it didn't drop that much. So this is $30.14. Actually, this is a really bad example because this is only a 2-cent drop. So my bad, this is a bad time frame on a ticker that doesn't move that much, apparently. So the concept is still the same, though. This is resistance, and it became support. So since it broke that line, it's showing you that it's acting as support, but it's not a perfect example of as clean as resistance, It did break below that line, but ultimately it did hold as support. So we got one candle below it, the next candle went right back above it. So I would still say that area is holding as support, even though it broke below that line. It broke for one candle and it came back above it. So support becoming resistance. The next concept is gaps. A lot of the plays that I put on Twitter and made YouTube videos for potential plays are based on gap fills. So a gap is a section on a chart where the opening price is significantly higher or lower than the previous close, creating a gap. If you look on this chart here, it closed here, and the next day it opened down here. So there's a huge gap between the closing price and the opening price. Gaps are important because there's a concept that says gaps will fill. Not all gaps will fill, but there's a concept that says gaps will fill. So when we're looking at this particular gap, we're going to be looking for it to eventually come back up here to this price level, because this gap should theoretically fill. So when we get to this level here, we're going to look for it to break above, and our first target, not necessarily our first target, but our ultimate target would be this area, whatever this dollar amount happens to be, where this gap was created. So let's go to a real world example. This is the best example I can give because this is a play I called out, I think on, this might have been Discord and Twitter. I don't think I did YouTube on this. One of the YouTube videos I did for chart review had this in it, but I didn't do a specific play on this. But when I did a chart review, I called this one out on YouTube. There's a gap to fill here. This was a $5 gap. So we closed here and opened here. You can see a nice big gap in there. And the reason this is an awesome example is because a few days ago it actually filled the gap. So we had this gap down. So I'm going to place my resistance line there. Let's actually zoom in on it. It closed here. It actually closed up here, but the low point was here. And the next day it opened here. And you can see that was because of earnings. So there's a gap down. That's where I'm going to put my resistance line. We spend some time underneath. We come and test it. When we break above that resistance, the area I'm looking for my target is to fill this gap. Because again, the theory says gaps will fill. So when there's a big space here, my first target is 51.86. This candle, the high, was 51.62. So we're within about 20 cents. We had a little pullback. Today, the high was 51.78. So today, we were within 8 cents of filling that gap. So if you know that, and if you know the theory says gaps will fill, if you do a scan for gaps, you have a list of potential trades. And you're waiting. You're not trading anything in here. Maybe you're trading the movement here. That's possible. But if you're waiting for the gap fill, you're really waiting for it to get to this area here. We got there, resistance. Got there, resistance. Got there, resistance. Okay, this candle punched through it. And from there, the gap was created over here. The gap was almost filled by, again, we're off, I think, 8 cents, I said. So we're off by 8 cents. So if you take a trade from 46.72 to 51.86, that's a pretty badass trade. If you're in options, that is an awesome trade. So gaps will typically fill. So I like to do a lot of scans that have gaps on them. And I don't plan the trade out right away because it might take some time. Here's an example. We closed here. We opened way down here. So if you look at this area here, there's a massive gap in the chart. We spent some time. So I put a line there as resistance where this candle opened. We spent some time below that area, but you can see we're slowly building back up. When we break through that level, my target is to fill this gap. And perfect example again, because today, and actually a week ago, on 1/8, we did fill the gap. So this is $39.40 right here, where we gapped down to $39.40. We're at $56.51. So if you buy a $40 call on this particular day for, let's say, 2 months, 3 months out, and the time frame would be depending on how much this ticker moves in a given day. So if I know it moves $3, $4 in a day, I might take 1 or 2 months out. If I know it moves 40 cents a day, I might take 6 months out. So the time frame depends on how quickly the ticker moves. But on this one, this is the resistance. When we break through this level, $39.40, let's say you took a $40 call. And this one from here, it took about 2 months. So based on the movement of the ticker, it took 2 months. We know that because we're looking at the chart. Since I don't know that ahead of time, maybe I take a 2 or 3 month contract. When I'm looking at the gap, I would look at the average movement to determine what time frame I need for the gap to fill. So I'm saying 2 months because I know it's 2 months because I have the chart in front of me. If I don't know that ahead of time, I'm going to look at the average movement for the ticker to determine how much time I think it needs to fill the gap. But perfect example, there's a huge gap to fill. If you bought a $40 contract here, you made money and gave it back, but it tested this support level. Remember, prior resistance becomes support. We broke through it, it came back to test that level. That level held as support. That is a good indication to go long. So if you took a $40 call option for 2 or 3 months out, it's now $56.51. You made an awesome trade. And if you're trading options, that is going to be a killer trade. So the theory says gaps will fill. Do a scan for gaps. Give yourself time frame to see whether or not it's going to fill, and take a long position to work on filling that gap. Target. Target has a lot of gaps. There's a gap down here. It eventually filled. There's a gap up here. That one never filled. There's a gap up here. That one never filled. There's a gap up here. It filled it by creating another gap. So target is just a gappy stock. So the theory says gaps are going to fill. So will this fill? I don't know. Because this is going way down to 87, it's currently 113. So if something horrible happened to target, we can put a resistance line there, because resistance, resistance, resistance. So maybe $90 would be a target. And then eventually 87 to fill the gap. Of course, you're going to have support there. Maybe you find support there. So it's not going to go magically from here to here. There's support levels in between. So will this gap fill? I don't know, because that's a pretty big drop. So again, I want to show you that support and resistance and the theories of gap filling, it doesn't all work out perfectly. It's not all going to work out perfectly. TRV, travelers. We have a gap to fill here. It filled the gap. This is 134 to 140. $6 move, 134.61, so more of a $5 move. $5 move in options is going to give you a killer return. So if you bought a 135 call and it's now trading at 141, you probably made good money. Gap on the chart, gap filled. Gap on the chart, gap did not fill. There's a gap over here. We closed here, we opened here. It created a gap in the chart. Over time, that gap filled. You can see the downward movement back to where this prior candle was. So we created a gap here. Over time, the gap filled. Look at this. We closed here, we opened here. So there's a gap created right here. We're working on filling the gap. Will this one fill? I don't know. It's going to take a big movement down to fill that one. So again, not all concepts are going to work out perfectly. Here's an example where we have a nice gap up and it filled to the downside. We have a nice gap up and this one did not fill. We have a nice gap down and this one's working on filling it. So gaps are important to look at because the theory says gaps are going to fill. So a lot of my scans, I look for gaps, because I'm going to time a longer term trade and coordinate the movement of the stock to how much time I think I need for that gap to fill, and then take a 3 or 4 month position, maybe a 6 month position, maybe a 2 month position to work on filling that gap. False breakouts. False breakouts are basically when we have a breakout of a resistance or support, but it does not hold. It fakes us out. If you look here, we have resistance, resistance. We're building up under resistance. We finally break out, but it does not hold, and we're way below that line. That's called a false breakout. So if you're looking for this trade and you see it breaks resistance and you get in, and then all of a sudden you're way down here, you go, oh man, what happened? It broke resistance. That is a false breakout. That happens from time to time where this is not a sustainable breakout. It's going to give that move back and then drop further. $3M. We have clear resistance over here. We broke above that. We were above it for a few candles, and then we gave it all back, and we're below. And we're working on filling this area here. It's just kind of bouncing back and forth. But if you have your resistance line drawn here and you see it break above here, that's awesome. I'm in a trade, great. It didn't work out. Was it a bad trade? No. You broke through resistance. If it was a scalp, you made an awesome trade because this went from, the resistance was 172.48. The high of this candle is 175. So you could have made a $2.50 to $3 move. So if you scalped it, you could have made a great trade there. But if you took a longer term position, you're now in the red. So this is a false breakout. It broke above prior resistance, but it couldn't sustain it. Okay, next topic. How do we use this to time our entries and exits? This is kind of what everyone wants to hear. This is the big part of it all. And I'm going to take a break here and go through some of the comments just so I don't fall too far behind on any of those. Okay, there aren't too many that I'm behind on. Whole numbers and quarters work like 25, 50, and 75. Yes. Depending on the price of the ticker. If you're in a $13 stock, $13.25, $13.50, $13.75 will also be potential points of support and resistance. The gap doesn't have to happen after hours. It will frequently happen for earnings. If you have an earnings beat or miss that's widely unexpected or worse than what was expected, gap, maybe something closes at 120, they miss their numbers, the next day it opens at 112. That's going to create a gap in that chart between 120 and 112. And the reason for that is it's closing at one level, and the next day it opens significantly higher or lower than where it closed, creating that gap. So during hours, I forget what ticker I was trading one day. BA will do this. If you look at Boeing on a 1 minute chart, you can close 1 minute candle at whatever dollar amount, and the next minute candle opens like 70 cents higher. So you can get gaps on a 1 minute chart. As far as trading the gap on a 1 minute chart, I don't pay attention to that. That's not a gap fill trade I'm going to make. So if one chart, Amazon might do this, but I know I was in BA one day, and I know this because, I remember this because the trade went against me. So it was BA. I don't remember the dollar amount, so I'm just going to make up. I know BA isn't a $100 stock, but for the argument's sake here, I'm going to say $100. So it was dropping, and I bought, let's say, a $100 put. And then it goes from 100 to 99.70, 99.60, 99. I'm going, okay, great. It's moving in my direction. Awesome. And then it goes from 99.60, it gaps up on the 1 minute chart. The very next minute, it closed at, let's say, 99.60. The next minute, it opened that candle at like 101. And I'm like, what the hell just happened? It had a nice gap on a 1 minute chart. And it went against me. It gapped the wrong way. So gaps can happen on a 1 minute chart, 5 minute chart, weekly chart, monthly chart. It would be rare to see it on those longer time frames. It would be pretty rare. But on a daily chart, look at earnings season, and you'll find gaps all over the place. So those are the ones I like to look at for trades for longer term swings. So gaps can happen on any time frame. It's harder to find one on a monthly chart because if you think about it, from 1 month closing to the next month, it's going to have to make a drastic change because that one candle covers 30 days of the month, 20 trading days. So on a daily chart around earnings, it'll gap up or gap down depending on earnings beats. I don't play the gap on a 1 minute chart. That's not a gap play that you're going to make. But if you find them on a daily chart, time it out, play those gap fills. I showed you 4 or 5 examples just now of how they do fill the gap, and then 1 or 2 where it won't. So it's not a guarantee. But look for those gap fills. So how to time entries and exits. That's a key factor of why we use support and resistance. We're coming up on 3 hours. I did not intend for this to take so long, so thank you guys for sticking around. This is probably something you're going to want to watch later on in maybe 30-minute or 1 hour doses. I don't blame any of the people that have left at this point. There are some of you guys who are not sticking around. I just realized we're going on about 3 hours, and I'm trying to speed it up. There's just so much information that I want to give you as far as how to use it, why it's so important that I don't want to take a 30-minute seminar and then you guys are like, wait a minute, I don't understand this. You didn't really go over it. So if you guys have been through some seminars with me, you know I'm a blabbermouth. You know I can talk for hours and hours. We're going on 3 hours and this is insane, and I deeply apologize. I did not mean for it to take this long. when I created this slideshow and kind of rehearsed it really quick, it wasn't even close. So I'm going to tell you again, I'm going to speed through this. If you have questions, please type in that chat room. I will check it out periodically, but I don't want this to be a 4-day seminar. So I'm going to try and zip through the rest of it here, giving you enough time to really sink in and understand. I don't want to skip over it, but I do want to get through this. How do we use these to time entries and exits? For me personally, there's 2 types of trades that I'm going to take. If you look at this chart, point 1 establishes a resistance line. Point 2 confirms resistance. Point 3 is the breakout. So the first trade I'm going to take with this is a scalp. When I break above resistance, I'm going to scalp that to the upside. That is a short-term trade based on resistance breaking. I might be in and out of that trade in 7 minutes, 3 minutes, an hour and a half. Resistance breaks, I'm scalping that to the upside. And I might stay in that for a swing. I'm watching to see what it does, but my first initial trade on that is going to be a scalp because I don't know if that's going to be a false breakout. Point 4 is the first test of that line. This is my favorite type of trade for swing trades. Point 1 is resistance. Point 2, resistance is confirmed. Step 3 is the breakout. 4 is the test of support. So what I'm looking for on the breakout is prior resistance becoming support. So we call this the test. We broke above resistance and it's coming back to test that line. 2 things can happen. It can break below that line and this is a false breakout, or that line can hold as support. Since this line held as support, that's my second trade, which is going to be a longer swing. So the first time it breaks through resistance is a scalp or a day trade. It might be a swing depending on what I see happening. But my first trade is immediately going to be a scalp because it broke through resistance. My longer term swings is let it do whatever it's going to do. Let it come back and test that area. If it tests that area and holds as support, that's my indication that it's safe to get into a longer term trade because prior resistance is now support. So worst case scenario, if it goes up, I think it's going to drop back to this line because it showed me that it's going to hold as support. So low risk entry here. If it happens to break support, it's low risk because I can get out of this trade with minimal damage because I'm in close to that level. So if it drops below, I can get out pretty quick. If I'm in way up here and I'm waiting for it to test support, I'm giving it all this room to find out if I'm wrong. And then if I am wrong, now I'm giving it room down here for me to exit. If I'm in as close to this support level as possible, if I'm wrong, I'm getting out as close to that support level as possible. That trade, even though it's against me, isn't going to hurt me. If I'm in way up here and I have to let it go all the way down here to test, now if that doesn't hold, now it's going to hurt me. So I want to enter as close to this line as possible. So my first trade is a scalp when that line breaks. My longer term swing is when that breaks. I'm ignoring everything that's going on here until it comes back to test that line. When it tests that line and holds, that's my longer term swing. Here is McDonald's. I don't remember the time frame on this chart because, like I said, I actually had this prepared a while back, months ago. So I don't know the time frame on this, but this level here you can see is resistance. We're building up under resistance. It's under resistance. It can't break through, but you can see it's not dropping down here either. It's building up and building up and building up. We're going to wait for this to break above that resistance. What I like about this setup is that it's building up under resistance. And that's important because it's not dropping. It's not hitting resistance and dropping. It's spending time consolidating, which you would think is normal, right? We're down here. We have a run, a little pullback, a run, little pullback, run, pullback, run, pullback, run. So from down here, it's not a massive run. So it's not unusual to see it consolidate before it's either going to continue to the next leg up or find resistance and drop. So we're in consolidation under resistance after a massive run. I like that it's consolidating here and it's not dropping further. So that's something I'm going to watch for, that break of resistance. And when it breaks that resistance, again, that's a good entry to go long. If it's a false breakout, as long as you're in as close to this resistance as possible, you can get out when it breaks as close to that resistance as possible. So that trade is not going to hurt you even though it went against you. If you go in way up here and now it goes all the way back to test it, now you've already given up 7, 8, 10, 12, 20, depending on the ticker, whatever dollar amount this movement was, you're giving all that up to see if this is going to hold a support. And if it does, great. But if it doesn't, now you gave up that $10 or $20, and now you're going to give up another 3 when you find out that that did not hold as support. So we want to time our entries as close to support or resistance as possible. So when we see this resistance break, we can time our entry there. And if it turns against us, we get out of it when it breaks below. And we can get out of that with minimal damage. And the reason for that, again, is because we're in as close as possible to that support line. So this is actually the chart that I was just looking at there. You can see it building and building and building. It's consolidating under this resistance level, but it's not dropping. It's not getting rejected. It gets rejected down to this point here. So it goes up, gets down, goes up, down, up, down, up, down. So there's a little channel here. If you remember the first few slides, sideways channel, that's consolidation. But it's hitting resistance, but it's not dropping deeply. So it's just kind of consolidating. So once it breaks through this level, you can see that was 145. It went straight to 151.33 before it even had a red candle. That's a $6 move without a red candle. So I like to see that it's consolidating under resistance, and I'm waiting for a break of that resistance. So I think, okay, so here's another example. And this is going to show you the 2 types of trades that I like to take. We have a resistance over here for WDC. This is back in October, end of October. We have resistance here and then a big gap down. Then we spend some time down here. So we have resistance. We're down here. There's a gap, so maybe this is on a gap scan that I'm watching for this level here. When it breaks this level, I'm watching for that gap to fill. Okay, so it might have come up on my scanner for the gap fill. But I know there's resistance up here. It's consolidating under that resistance. It's not getting rejected heavily. It's just consolidating and going sideways. So here are my 2 trades that I just spoke about. On this day, when it breaks above that resistance, I might scalp it. And that resistance is 63.09. The high of this day was 63.51. So it would not have been a great money-making trade. That's why my first break of resistance is a scalp, because I can be in and out. And if I only captured 40 cents of that, maybe I got 10% on an options contract. Maybe I got 5%. Maybe I lost money because it wasn't a huge movement. That's why the first movement for me above this resistance is a scalp, because I don't know whether it's going to hold and run or give it back. Now, since it closed at the high of day, that's a strong sign. So I might have held that, I might not. I don't want to say what I would have done because I'm not in the trade, so I don't know. I don't want to say, oh, I would have held it, and look at that, it gapped up. I'm so smart. It closed at high of day, which is a good sign. That's a sign of strength. But would I have held it? I don't know. So I'm not going to sit here and say I would have held it because I can see the chart and I see it would have been good to hold, so I'm going to tell you I held it. I don't know. I probably, in honesty, would not, because my first trade on a break of resistance is a scalp. So my intentions are to get out of this trade the day that I got in it. Now, the only thing I'm saying is a bit of a wrench thrown in is that it did close at high of day. So when I see that it's kind of strong like that, it might be something I would watch to hold, but resistance from this day, it couldn't break above So I probably, in all likelihood, would not have held this for this gap. So this would have been a very minimal trade, or it possibly could have lost money. The first trade I like to take for a swing, if you remember, my first trade is a scalp when it breaks resistance. My first swing is when it tests that support for the first time. So this is resistance. When we break through that level, my swing trade is going to be when it first tests this level. And you can see it had a nice movement upwards. There's a $3 plus move here. That would have been a nice trade, but I'm not worried about what it's doing here. I'm going to miss that $3 trade and be happy that I missed it. The next day it gives it back. The next day it gives it back. It's testing this line. Prior resistance becoming support. It did break below that line, but it closed above it. So that's telling me this line is going to hold as support. Prior resistance becoming support. So now that I know this line is going to hold as support, now I'm going to take a longer term swing. So the fact that I missed a big move here, I don't care. I'm waiting for the first test of this line. It broke above it, it comes back down to test it, and it holds as support. If it doesn't hold as support, there's no trade for me. It's off the radar. I'm not looking to trade this anymore. Now it might come down here and test support or test resistance again and break through again. That's a whole nother trade. But the trade I'm looking to take based on this here, based on this resistance breaking, the first trade is a scalp. In all likelihood, I'm out of the trade that day. What it does after that, I don't care until it comes down to test this level. When it tests and holds, I'm going for a longer position. And you can see it went from 63 to 70. So that's a good trade there. And it took the risk off because whether this was an entry here and I got in here, I'm not willing to go from 65 to 61.83 to see if this area is going to hold a support. When it comes down to test it and it shows me that it holds, that's where I'm looking to get in for a lower risk entry. And if it doesn't hold, I can get in at 63.09 around there because that's the resistance. If I get out at 61.83, that's about $1.20 drop. That's not going to hurt me. If I'm in up here at 66 and it goes to 61, that's going to hurt me. So I want to get in as close to this line as possible. So I don't care what it does over here. I'm waiting for that first test. When it tests and holds, I'm going long for the swing. Now, let's use support and resistance to find out what's my target price on this swing trade. Clear resistance over here. So my first target is the high of this point here, right? We couldn't get above it over here and then we dropped. We're struggling over here, so my first target is to get back to this level here. We draw a line there, 65.31. The next day that it gapped, it reached that target. When I trade, I don't like to have one target because if it reaches that, then you have no game plan. Then you go, oh crap, what should I expect next? You might make good decisions, you might not. I like to have a game plan where it says, okay, if it breaks this, what's my next target? So what I want to point out here, the target I had listed was $70.73. It hit $70.50. So it hit close enough to this that when it gets up there and gets rejected, that's probably my exit because I see that it can't quite get up there. And even though it got close, it got pushed down pretty hard. So that's probably one of my first exits. If I'm in, let's say, 10 contracts, maybe I sell 7 of them and I hold 3 to see if it breaks above that. The question is, how did I get 70.73 as a target? There's no space up here. So why am I saying 70.73 as a target when there's no indication that it should get there? Again, go to a different time frame. Pull up a weekly chart. Over here, support, support. I'm looking for support to become resistance. So since this was support, since there's very little trading in between those levels, I'm looking for support to become potential resistance. So that's my target. If it reaches this level and gets rejected, support became resistance. If it punches through, I'm not going to sell. I'm going to watch and see what it does at the next level. My next target would probably be somewhere around here. And just to keep them clear on what I'm doing with the lines, let's change it. So let's make it blue because that's my target level. And that's chosen because this was support, support, support. So if we broke through 70.73, 75.96 would be my next target because this is prior support, potentially becoming resistance. So now you can start to see how we use support and resistance to really plan out our trades. And if someone says right now, hey, what's WDC or WDC, what's it going to do tomorrow? I have no idea. What I can tell you, if we go to the upside, I'm looking for 70.73 and then 75.96. Let's round it up to 76. So I'm looking for about 71. If we break above that, I'm looking for about 76. If we go to the downside, I'm looking for this prior resistance to become support. So this 65.31, I'm looking for that to become support. If that breaks, and this is back on the daily chart, 65.31, if that breaks, I'm looking for this resistance to become support again. So to the downside, I'm looking for 65.31. If that breaks, 63.09. So now you can start to see how we're using support and resistance to time our entries and exits, but also provide our target price for where we think it's going to go. So I hate the question, what is WDC going to do tomorrow? Because no one knows. So if someone says, oh, it's going to 70.73, you don't know that. Oh, tomorrow is going to be a bearish day, futures are red, it's going to go to 65.31. You don't know that. Futures could be super red and tomorrow we're green. Futures could be really green. We get news before the opening and we open red. So when someone says, what's WDC going to do tomorrow? I don't know. I have no idea. What I would answer, to see that upper level, again, I have to go to the weekly chart. I would say if we have a green day and I'm in a call position, I'm looking for target 1 to be 70.73. Target 2 to be around 76. If we have a red day, I'm looking for 65.31 to hold as support because it was prior resistance. And now we can go back to the daily chart to see it clearer. Prior resistance, I'm looking for those to become support. So if we have a red day, I'm looking for 65.31 to hold as support. If that breaks, I'm looking for 63. So when you hear people say, oh, it broke support, we should see 65, how do they know that? Well, they don't know anything magic about 65 other than prior resistance becoming support. So if we break down to this area, I would look for 65.31 to become potential support. So if we have a red day and this drops and someone says, oh, what are you looking at for the next area of support? That's how we get our 65.31. Oh crap, it broke 65.31. I'm in a call. Should I cut it here? What's the next level of support? Well, I'm looking at 63. Prior resistance. Now you can look at this candle and say, well, prior resistance could have been 63.60. Yes, it could have been. Again, there's nothing super scientific about this. Some of it is an art. So 63.60 could be your first target. 63.09 could be your next target. 61.83 could be your next. So you have levels. So when someone says, what is WDC going to do? I don't know. But what I have for you is if we have a green day, these are my target 1, 2, and 3. If we have a red day, this is my target 1, 2, and 3 to the downside. So no one knows the future, but when we give indications of what we're expecting, it's because it's based on support and resistance. What is support and resistance? Go back to the very first thing I said. What is support and resistance? Supply and demand. So let me break that down for you because this is why tickers move. And let's use this part as an example. So this is resistance. In fact, let me clean this up. Let me clean this up. And for argument's sake, let me just make 2 lines. So this is resistance. And let's just, or this is resistance here. Let me change that actually. Let's make that one support and resistance. So we have support here. You can see support, 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 support. So there's a few days where it's hovering above this. So that's a support level. And this is a resistance level. So what is this actually telling us? At 61.83, this is a desirable stock to own because people are buying it here. When it gets to 70.73, no one's buying it at this price because it's not a valued price. So when it gets to 70.73, it's too expensive to own it. If you're in it, great. But if you're trying to buy it, it's too expensive to own it because people want to own it at $61, not 70. If you're in it, you want to own it at 70, but you don't want to buy it at 70. You want to buy it at 61.83. It's an attractive price here. So when it gets up here, you can see it got all the way to 70.50 and then it got pushed back down. The sellers were in control. What that means is there's no one up in this $70.50 area that's willing to buy it at that price. So there's a lot of supply. There's little demand. People don't want it at $70.50. People do want to sell it at $70.50. So since there's a supply, the price is going to drop. It's going to drop until the point where someone says, I'd like to own it at this price. I find that valuable. To me, this is where I'm willing to own it. I would like to buy it at $66. At $70.50, it's too expensive. I'm not going to buy it. At $66, I'm willing to buy it there. So it's going to drop until it finds people willing to buy it at this price. That's supply and demand. Everything about the stock market is supply and demand. Why does a ticker go up? Because people want that ticker. Why does it drop? Because people want to sell it. They don't want to buy it. They don't want to own it at that price. They want to sell it. So there's a supply, but there's no demand. So just like the car lot, when there's 10 cars and one buyer, the sticker is 20,000, you can probably go in and buy it for 19 because there's no one else looking to buy that particular car. There's no demand for it, so the price is going to come down. Part of why Ferraris are expensive, one, they're amazing vehicles, but two, they're in limited supply. If 1,000 people want a Ferrari and there's 800 made in a given year, the price is going to go up and up and up. So if the sticker price on that is $350,000 and 1,000 people want it, but there's only 800 being produced, the sticker can be $350,000. I can guarantee someone's going to pay $375, $400, $450 because 1,000 people want it, but there's only 800 of them. So 200 people will not get that Ferrari. There's a demand, but there's no supply. So the price is going to be driven up. So look at that as the stock market. That's all the stock market is supply and demand. Down here, there's a demand for this stock at this price. Up here, there's no demand for it. So it's going to lower the value of that stock. People aren't buying it up here. They're selling it. It's going to drop until it gets to a point where people are willing to step in and buy it. Now there's demand at this level, which is why the price drove upwards. But there isn't a huge demand at this level, so more people are stepping in to buy or sell their position. So it's dropping the price again. So the stock market is all about supply and demand. So why won't this punch through $70.50? Because there aren't enough people that want to buy it at that price to drive it higher. The demand is not there. If the demand isn't there, it's not going to increase in value. So when we say don't fight the trend, if everyone wants to own this stock at $61 to $62 and you don't like this stock, so you're going to short it, if everyone wants to own this stock, let's say this is the biggest piece of crap company out there. And I'm not saying WDC is, I'm just using this as an example. Let's say this is the biggest piece of crap company. And you have a million reasons why this should be a $40 stock. So you're going to short it. If people want, for whatever reason, they want to own it at $61 to $62, all your reasons of why it should be short doesn't matter because there's demand to own it. That's going to drive the price up. So when you're fighting the trend, you're fighting all the people that say, I want to own it, I want to own it, I want to own it. You're the one person saying, I want to sell it. You'll sell that position really easily because there's a ton of people there that want it. The demand is there. So when you're trying to sell it, those will get scooped up immediately because there's so many people that want it. Up here, there aren't that many people that want it. So the price is going to drop until you get to a point where people do want it. So it is that simple. It really comes down to the stock market is supply and demand. There are certain patterns we use in technical analysis. I'm not going to go through these because I want to cut down the time on this seminar. And I didn't have a huge plan to go through these in the first place, but I'm going to touch upon it really quick. We have double top. You'll hear us say something about head and shoulders, rising wedge, double bottom, inverse head and shoulders, falling wedge, bull pennant, bear flag, all these terms. These are all patterns. What these patterns are showing us is market psychology. So the reason technical analysis is important to understand is because it's the psychology of the market. Where do people want to own? Where do people want to sell? That goes back to supply and demand. So if we use this example here for this inverse head and shoulders, there's a neckline here that they're calling this. That's a resistance level. People don't want to buy it at that level, so the price drops. It's attractive down here, so people buy it. But it gets to this level again, it's not attractive to buy it there, so the price drops again. It doesn't drop as far as this point here, so people start buying it up because it now becomes attractive at this level, and the goal of this pattern would be for it to break above this resistance and go further. So at that point, you can see it's not dropping further. I've done that like 7 times. I apologize for that. I am using a mouse that is much more sensitive than my other one. So again, it's not dropping, so people aren't willing to sell it because they think it's going to go higher. When it finally breaks above this, that's a bullish pattern. We're expecting it to go higher because all of a sudden at this price, it does become an attractive stock. This is a bull flag. This is AMD. We have a nice run up. We have a sell-off, people taking profits. That's a bull flag formation. The trade entry is when this downward pattern breaks to the upside. It broke to the upside, and you can see it went from $40 to $51.88. So a bull flag is when there's a big run upwards and profit taking or consolidation. A break above that pattern to the upside is where you would expect your trade entry down here. And the movement, the reason we use patterns, the movement, your expected target on this is the move from the bottom of this flagpole to the top of the flagpole. In this case, it's $14. When you get to this flag itself, when you break out of this flag pattern, this $14 move of the flagpole, you're going to add it on to this point here. So if we're at that $40 level, your expected target on this pattern would be $54. We're at $52. So you can see when we recognize certain patterns, they're going to play out in a certain way. All that is market psychology. So support and resistance is supply and demand, and it's market psychology. We have a flag pole, and we have some consolidation. So this is a bull flag. There's a long period of an upswing, and there's some sideways consolidation. So another example. Without it, I don't have the lines drawn out, so it's not as easy to see, but it's pretty clear if you follow the mouse. We have an upward swing here and sideways consolidation. So the expected move would be if it stays above this level of support, we're going to get an upward movement here. And why is that market psychology? Well, if you own it down here at 66 and it's now 88, that's a nice big swing. So psychology says, I'm going to take my profits. I'm going to lock that in. So we're going to expect to see a downward movement. You're going to see downward movement until the point where people want to own it again. And it's not going all the way down to 66 again, but it got to a point where people said, you know what? I'm okay owning it here. And why? Does anyone see? Give me a second. I'm going to switch back to the comment screen. Does anyone see why it stopped selling off right there? Type in that comment section if you can think of why this area here, instead of going all the way down to 66, why did this area stop here? And I'm going to give you a perfect example of something we already spoke about. Colonel Kane. Previous resistance becoming support. Look at this candle right over here, and we're going to draw a line there. The low point of this candle was 85.31. This was 84.73. So we're off by a little bit. But the reason I would expect this not to drop back down to, say, this level here, this level here, this level here, this area of resistance, if we're dropping, my first level to watch would be down in this $85 area. And you can see it didn't quite get down there, but it got close to it. It's off by about 60 cents, but it came down towards that area and then started moving upwards. So when you're in this position and it's dropping, and you're going, oh crap, it's moving against me, where is it going to stop? We don't know, but we do know that prior resistance would be support. That doesn't mean it's going to be support, but that's what we're looking at for support. So my first indication of where I might want to exit is if it breaks below this 84.73 and starts moving downwards. So as long as it holds above this area here, I'm okay watching it drop from this level to this level. That's a whole nother seminar on managing your losses and stop losses and moving your stop up to protect profits. But if we see this level as prior resistance, I'm going to look for that to be support. So if you're in down here at 60, 70, 75, and it's now up here at 90, depending on the type of trade again, if you're in short-term trade, you don't want to see it go from 90 to 85. But if it's a longer-term trade, I'm going to use this area here that was a prior resistance to act as support. So if it's up here at 90 and it goes down to 85, I'm still comfortable holding that because that's a normal pullback to the prior level of resistance. The reason we have these patterns is because they repeat themselves over and over. I'm going to speed through two more of them here. Double bottom and double top. That's an area where we have a bottom, and then it climbs. A double top is where we have a top, and a decline. Now I said before we don't like 2 points to prove a trend, but this pattern is called a double bottom where it bottoms out, it climbs, it bottoms out, and then it makes an upward swing. This is kind of a double top. We have a top period here, it drops, it climbs to that same top area, and then it drops further down. The other reason I like this one is because prior support became resistance. This is about as clear a slide as you can get, as clear a chart as you can get. Prior support became resistance. I'll move the mouse so there's nothing blocking that view. That's as clear as we can get. So when we say if support breaks, get out of your trade, if you're in this trade at this level, when support breaks, it never comes back to that level. It tests it, and when it doesn't get through that level, you're never getting back to that level again. So if you're in a call position here, when support breaks, get out of your position. Do not hold on to that thinking it's going to come back. It might come back, and if it does, get right back into your position. But do not, over time, hold these positions thinking they're going to come back. They will from time to time. The majority of the time they don't. And when they do, you just open your position again. But you don't want to hold it thinking it's going to come back at $28. And now you're down here at $19.90 thinking, oh man, I got a long way to go just to get back. If you're in this trade because it's held support, when support breaks, get out of the trade. Don't sit in it hoping it's going to come back to this area. Inverse head and shoulders, DPZ. We have a shoulder, we have the head, we have the shoulder. This is an inverse pattern. To make it a little easier, let me flip this chart upside down. This is the same chart, but upside down. You can see, and actually let me do this to make it really easy. So the head and shoulder pattern is basically, you're going to have a shoulder, you're going to have a head, you're going to have a shoulder. This is called the neckline, and we want to see a movement to the downside. If we draw our person in here, this is charting at its best. You will not see this ever again. We have two arms in there. Is that not the best chart you've ever seen? That's why it's called a head and shoulders. Excuse the 2-year-old in me. We have a shoulder. An upward swing creates the head. Another movement upwards, but it doesn't quite get to the top of there. That creates the other shoulder. The point of this is that when it breaks this neckline, we would be looking for a downward move. Now, this is the inverse. I flipped the chart upside down. I'm going to put the chart back to where it actually is. This is how you would see the chart if you pulled it up. So this is the shoulder. In this case, it's going downwards because this is the inverse head and shoulders. There's the head. There's the shoulder. This is the neckline. The trade to take is when that neckline breaks to the upside. You can see it does that over here. And when it breaks to the upside at around $250, it went up to $300. So, recognizing these patterns is important. We want to recognize these patterns because it's market psychology. It's not magic, it's psychology. We have a sell-off here and people want to buy it. We have a bigger sell-off, people buy it back up. It sells off again, but it doesn't go and make a new lower low. People are buying it back up. So what we're waiting for is where are people going to find this point attractive to buy it with volume and drive it higher? And you can see when we finally get that movement upwards, there's a big upwards movement. So it's important to understand patterns because what the patterns are showing us are historical movements that we're going to use to potentially play out the same way now as they played out in the past. Technical analysis does not always work. This is a descending triangle. This should be a bearish pattern. This is a series of a support line with a series of lower highs. Each time it bounces off support, it makes a high, but it's lower than the previous high. It bounces, it makes a high, but it's lower than the previous high. It bounces, makes a high, but it's lower than the previous high. This is a pattern that's bearish. What we're looking for is a break of this support line to make a downward movement, and this one did the exact opposite. So I want to point out, technical analysis does not always work. It does not always work. Clusters. This is not necessarily 101, so I'm going to skip over this. Clusters are basically when you have multiple support or resistance levels in the same area. So these two lines are different Fibonacci levels, which I'm not going to get into, but Fibonacci is a form of support and resistance. The blue ones are one time frame, the yellow ones are another time frame. And if you look here, on this particular line, the blue and the yellow match. That's a cluster because we have multiple time frames matching, and you can see that area is support, that area is support. That should act as a strong support because we have two different forms of support and resistance lining up to each other. Fibonacci retracement and extensions. This is a form of support and resistance. It's not support and resistance 101, so I'm not going to get into it too much. It is a form of support and resistance. So if you hear people saying, oh, what's the next fib level? Where is this stock going? It's in blue sky territory. We don't know where it's going to go. We can use Fibonacci extensions to give us an idea of where it's going to go. It's a whole nother seminar. I'm not going to get into it other than to say Fibonacci retracement, Fibonacci extensions, Fibonacci numbers we use all the time to give us an indication of support and resistance. And I'm skipping a few things here as far as the charts to kind of speed up this. We're almost done. Again, thank you guys for sticking around. There's a lot of information I want to give out to you guys. We are going to wrap it up soon. And by soon, I probably mean I'm going to ramble on, so don't take that to heart. But let's get into some tips. If you're using support and resistance on different time frames, or for your stop loss and target, use different colors. Multiple time frames, different colors. So let me pull up where the corresponding. Okay, so WTC. We said before, I kind of ruined this slide actually. The colors that I erased before were colors that I needed for this slide, so I messed up my own presentation. But we had resistance here, and if I remember correctly, since I know how I like to do my charts, that one was red. So we have resistance here. If we're getting into this trade based on that's how I had the chart initially. So if we're getting into this trade based on a break of this resistance, my target 1, I can do it in blue, so I know it's not just a support resistance level, that's my target level. My target 2 is in blue, so I know that's not just a support resistance level, that's my target level. My stop loss is red. So if I'm in a trade on a 1 minute time frame, I can't see those lines. It's too far above those lines. So if all of a sudden I see a red line in here, let's say it comes up upon this, and I'm seeing a red line, without pulling out to the bigger chart, I know, oh crap, that was my stop loss line. Or maybe I had a support line in there. And I'm going, okay, that's support. That's kind of where I'm looking for it to hold. It didn't hold support. If it breaks this line, I've got to get out. That's my stop loss. Without pulling back to the larger chart, I can see that when it's approaching a line based on the color, I can tell what is going on with that particular line. Is it support or resistance? Is it my stop loss? Is it my target level? I can see that with the different colors. So that's based on using support and resistance and your charting platform to make it easier for you to understand. Now, the next thing I'm going to say, if you guys are in our trade room, you're going to think I'm talking about a specific trader. I guarantee you I am not. And the reason for that is if you know the particular trader you think I'm talking about, this is one of the absolute best traders I have ever seen. This guy knows the markets. He knows how to trade. He knows every single line that is on his chart. So, this is not an insult to someone you might know in our chat room who has charts that might look something similar to this. His are not as extreme as this. I made a mess of a chart to point something out to you guys. And if you guys have seen Pete's charts in our Discord room, Pete is one of, and I'm not even exaggerating, he's one of the absolute most amazing traders I have seen. He's got 150 lines on his chart. He knows exactly what every single one of them are. He knows exactly what every single line on his chart represents. Because he's at such a level and he draws the lines, so he knows why he's drawing them. He knows exactly what every line on his chart represents. If you're brand new to support and resistance, do not do that. And again, it's not an insult to Pete, because I will personally be the first one to say he's one of the most amazing traders I've seen. He knows exactly what he's doing. I'm talking to you guys who are brand new to technical analysis. Do not let your chart look like this. Does that hurt anyone's eyes? If you are brand new to technical analysis, do not let your chart look like this. I have seen on YouTube, people will put a chart like this and they'll tell you, I knew BA was going to $300. I had it clearly marked on my chart, and you're like, what the hell are you looking at? There's a few reasons you don't want your chart to look like this. The obvious one is I can't see anything that's going on here. There's a really practical reason why, as a beginner, you don't want to do this. There's a really practical reason beyond I can't see what's going on. So if you're new to technical analysis and you're new to drawing lines, it's fun. You can see a resistance here. You can see support here. I want this one green. I want this one blue. Ooh, I like purple. Yellow is my favorite color. I'm going to make 17 yellow lines. Here's the thing. If you know what the lines are and you can use them properly, draw your support resistance however it makes sense for you. If you are brand new to trading, here's why I don't want your charts to look like that. There's a million reasons why I don't want your charts to look like that. But let's zoom in on a portion here. So we have a support line here. We have a gap down. You're in a trade. You see, well, there's resistance here. No, there's probably some resistance there. Ooh, look, there's resistance here. So let's say you start drawing lines everywhere you think there's support and resistance. And I'm not really looking at the chart. I'm just literally throwing lines up on here. So don't ask, why did I choose that line? I'm just literally drawing lines at candle points. But let's say you get excited and you start drawing lines like this. I have a valid support and resistance line at all of these points. You're in a trade here. You know support is down here. And it's not holding your support level. And you go, oh, wait a minute. This candle here, though, the low is right there. So I'm going to move my stop down to that level. It breaks that level, and you go, yeah, but the next candle down stops there. It's only 30 cents down. I'm going to use that as my stop. Oh, that's a good one, because see, this candle here, that's support there also. I'm going to use that as my stop. You're doing good. You're doing good. It breaks that level. You go, oh, crap. Oh, but you know what? The next support level's right here. I'm going to use that as my stop. It broke that. Oh, crap. Well, there's support here. It's only 40 cents further down. You can draw support and resistance at so many points and convince yourself that it's only 30 cents further down, that if you're in an options contract, you've support and resisted yourself down to zero. Because it's only 30 cents further, that's support, I'm going to let it drop 30 cents. That's a valid way to trade. When you do that 17 times 30 cents, now you're $430 away from where your stop loss should have been, and you keep justifying why you can pull your stop loss further because it's only 40 cents further. Damn, that one broke, but you know what? The next one's only 70 cents further. $600 further down, your options contract that you paid $400 for is now worth $7, and you're going, wait, what happened? I was charting support and resistance. You supported and resisted yourself down to zero. So, if this is your chart, you're going to convince yourself that you can hold a trade a little bit longer than you should because the next level down is only 30 or 40 cents away. If you do that every 30 or 40 cents, you're going to support and resistance yourself down to zero. Do not have your charts look like this. Don't do it. What you want to do is find your major levels and use those major levels, but do not make this your chart and convince yourself that another 40 cents is the real level of support. Yeah, that one broke, but you know what? 47 cents from here is the next level of support. I'm just going to give it to that one level, and then I'm out. It didn't hold, but you know what? I was wrong. 13 cents. Now I can afford another 13-cent drop. Oh, that didn't hold. Where's the next one? You know what? I'm just going to hold this. You know what? It was supposed to be a scalp. I'm going to swing trade this one. When you do that, you're support and resisting yourself right into a horrible trade. Do not let your charts look like this. And I wanted to put that disclaimer about Pete out there before I showed you this chart because he is an amazing trader. When I say don't let your chart look like the other one, I'm guessing if you guys have seen Pete's charts, someone in there is going, oh, is he talking about Pete? And I'm not, because Pete knows exactly, if this was his chart, he would know exactly what every line on this is all about. Do not do this if you're new to technical analysis. Do not do this if you're new to trading. Clean charts. The concept I want to get through one more time is when support breaks, exit your trade. Do not hold on hoping it's going to come back. This is an extreme example. This is a 10-year chart for a Rite Aid. It's down here in the $20 range. It went up to $190. I would never place a trade on this type of a chart. I'm going to use this as an example for you though, because it's going to illustrate exactly my point. When support breaks, get out of your trade. Let's zoom in. Let's say, let me zoom out to show you why this line. I've got support here, resistance, resistance, resistance. We did break out here, but this is a line of resistance. So it's the line I have over here. That's why this line is there. So you see this is a line of support. You open your call position or you take common shares. This is going to go up in value. It's on support. It's bouncing off support. I'm going to open my position here. It goes up. It comes back down to test that level, but that level does not hold. When your support breaks, get out of your position. If it turns around and goes up again, you can get back into your position. If you bought here because it bounced off support and you saw support did not hold here, but you're staying in it, you're staying in it. This is August of 2018. And you're thinking, well, it'll come back. It always comes back. It's going to come back. I'm going to hold on to this, and it's going to come back. August of 2018, support broke. The next month, September, confirmed that support broke. This is confirmation that support broke. September of 2018. Here we go. We're over here in January of 2020. You are still underwater. If you owned it at $27.60, it is now $12.86. You are still underwater from over a year ago. When support breaks, get out of your trade. Hey, but Mike, what if it was a fake out like you said before and it's going to turn around and make a ton of money? Get out of your trade when support breaks. Guess what? If this is a confirmation that support is going to hold, open your position again. Ride it up from 30 back to 150. But if you're wrong and support doesn't hold, you're in August of 2018 at $27. We are in January of 2020 and it is now $12.86. You are still underwater by about more than half. So for those of you who don't believe when we say if support breaks, close your position, here's an extreme example, but a year and a half, and you're at half of your entry price. So if you guys hold on to things when your support levels break, I don't want to see you lose money. I'm not going to point fingers and say I told you so. But I told you so. If support breaks, get out of your trade. If it turns around and confirms that it's a fake out and support is actually going to hold, you can open that position again. But when you're in at 12 or 27.60 and it's now 12.86, you can't do anything but either hold it, hoping it's going to come back, hint, it's not, or close your position for a major loss. If support breaks, close your position. That is why we tell you over and over. We get so many questions in DMs and in our live trading day posts in the main chat room. Hey, support broke. Should I get out of it? Yes. If it turns around, get back in. But if it doesn't hold, get out of the trade. So, I am going to, give me 1 second. I am going to be right back. And I'm back. That was a little more than a second, but I am pretty damn good at accurately guessing my time frame. Here we go. I am going to do a lightning round. I am going to show you guys some examples of things. A little bit of everything that I spoke about today. And it's going to be a lightning round, so don't worry if you miss some of this. You can always go back and check up on it, because I do not want this to go over 4 hours, and we're almost there, and I am so sorry for keeping you guys this long. It was not meant to be a 4-hour seminar. Like I said, for anyone who wanted to watch it and bailed, for you guys that are sticking around but are just exhausted at this point, you can go back and look at it in hour increments or whatever. But I'm going to do a lightning round. I'm not going to explain these. I'm just going to go through a bunch of stuff that we spoke about today. This is a weekly chart for IP. This is the support resistance zone. You can see a bunch of candles get into that area, but it doesn't break above it. That is a zone. This is Duncan. This is resistance becoming support. Resistance here, resistance here, resistance here, support here, support here. Support becoming resistance. So the reason I'm going to do a lightning round is because I want you guys to see multiple examples that I'm not making it up. It's not a rare occurrence. The stuff I'm talking about is on multiple charts, multiple time frames. Resistance, 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 resistance. The point of this is multiple time, or not even multiple time frames, but long time frames. This is back in March of 2018. If we come over here in June of 2019, that same level that was resistance is now resistance again. This one, support becoming resistance, resistance becoming support. We have a zone in here. So you can see multiple occurrences of what I'm talking about on a specific chart. I'm going to switch over to a daily chart. This is Tesla. And what I wanted to point out here is resistance, 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 resistance again. This was a long ways down at 360. But what I wanted to point out here is that way back here we had resistance at 360. And here it is again, resistance at 360. The other thing I want to point out is I said whole numbers, right? 1, 2, 3 times it couldn't get above 360. It bounced its head 3 days against 360, couldn't get above it, got rejected. And now, Tesla's just a monster now. But we have a line drawn way back here in January. We're way over here in November, and that same line is holding true. And then this year, Tesla's just, the rest is history. KHC, what did I like about KHC? KHC, I like the sideways channel. There's a sideways channel we talked about. It has an upper level and a lower level, and it's bouncing between the two lines there. KHC, sideways channel. STOR. So I'm going to call out these tickers because you guys can pull them up on your chart. So you can see that I'm not making things up. I'm not exaggerating. You can pull them up on your platform and you can see exactly what I'm looking at here. So let me change the time frame here. This is a support level here, 912, and it's a support level here at 1.2. So again, we draw this line back here. We forget about the chart for a while. Months go by and that same level is holding as support. So again, when I said we don't have to know why a specific level is acting as support or resistance, we just have to know that it is acting as support or resistance. This is a perfect example. Why is this level holding? I don't know. I don't care. But I know that it's holding here as well. RTN on a daily time frame. Horizontal support. 1, 2, 3, 4. Every time it bounced in that area held as support. ABT, upwards channel. It has a lower level and an upper level. Every time it hits, it's bouncing between the two. Upwards channel. We spoke about that when it came to patterns. Not exactly patterns. This was a little bit before that, but one of the patterns, this is an upwards channel. So we're going to look to play the bounce between the two, or we're going to take a long-term position riding in the direction of that channel. So when it pulls back, we're not worried about a pullback because the channel is upwards. W. Let's zoom in here. What did we speak about that you see on this chart? We have a gap down. We have a gap fill. We have resistance. We have a false breakout. We have a breakout that you can scalp. We have the first retest of that support resistance line. It holds. We have a long position. So those are the two trades I take, right? We have a resistance level. The first break is a scalp. Whether it's climbing in this area, I don't care. I'm waiting for the first test of that level. It does come down and test it. 2 days we see it holds as support and then it goes up. That's my entry for a longer term swing. AIG, what do I like about this one? Support, support. So the concepts that I'm talking about, they hold true on multiple charts, multiple time frames. Support becomes resistance. So this is an interesting one. I will spend a little bit of time on this one. Not even a little bit, just kind of real briefly. So there's a gap fill. Hasbro came up on one of my gap scans, so I have this on watch. I was trying to point out to someone, what do I think this ticker can do? So I'm playing it for this gap fill. That's my ultimate trade. We got to below here. This is before it broke out. I'm watching this line here because this is resistance, so it breaks out. And then it starts pulling back a little bit. So I was trying to point out, so what do I think this ticker is actually going to do? If you look at these aren't regular lines. These are actually arrows. So what I did was I was trying to point out to someone what I think this ticker can do. I didn't have any time frame on it, so I'm not pinpointing that it's going to drop to support at this level and it's going to break resistance at this level at the end of the arrow. They weren't time frames. They were just my thought of what this could potentially do. So when we see this break of resistance here, I don't think it's going necessarily straight up here to the next level of resistance. What I thought it would do was climb, pull back a little bit to this resistance line, and I want to see this resistance line hold, and then I want to see it go off and test this level of resistance. So when it breaks through, what I want to see is a healthy pullback. I want to see this line test and hold as support, and then I want to see it go long and break this level. These lines were drawn way before it actually did this. Unfortunately, I can't prove that because I don't have a post that I can show with a timestamp, but I was drawing these lines when it was back here, when I was thinking, when this pulls back, what kind of movement am I looking for? What I'm looking for is a pullback to this support because it was prior resistance. I want to see this hold as support. And if it does hold as support, I want to see it go long for a break of this resistance. So you can see it did bounce off and then it came back down. So I wasn't right in the fact that it would just make a test and then a move. but I was right in the sense that it would pull back, it would climb a little bit, this would hold a support, and then it would make a move up. So support and resistance, it's not magic, although sometimes it seems like it is. Because I know how support and resistance works, I'm looking for a test of this line and then a move towards this resistance, and sure enough, my time frame was off. Again, this wasn't the time frame I thought it would happen, but my general time frame was that it's going to test this and then go test this one. It did, and then it had another pullback before it went up, but it did what I was kind of expecting it to do. That doesn't make me a genius, it doesn't make me magic, it just means I understand a little bit about how these tickers work based on support and resistance. What is this? Sideways channel. Can you trade between these channels? In this case, you wouldn't want to be in a position on this channel because this is a 1 minute chart. This is 209.60 to 210.63. So this whole movement here is $1 up and down. So you wouldn't want to trade it up here, down to here, up to here, down to here. It's not a wide enough movement. When it breaks out or breaks below, you can trade that. JNJ. The reason I had this one pulled up, I want to point out the 34 moving exponential average that I was talking about earlier. You can see we're in an uptrend. It holds as support. When we're in a downtrend, it acts as resistance. We have a nice upward movement here. Support for the 34 exponential moving average. It's climbing, climbing, climbing. This is November. We're climbing all the way to the end of December. So this is an entire month of climbing. When it pulls back, look where it pulls back to. Almost to the penny, it pulls back to the 34 exponential moving average. So I spoke about moving averages. I spoke about how I like the exponential 34. Perfect example. 34 is support, we pull away from it. When we retrace on a pullback, it pulls back right to almost to the penny to that 34 exponential moving average. I think I'm going to cut this a little bit shorter and just go through this as potentially, I'm going to look at my notes, but this might be the last chart I show you guys. And let me get rid of that 34 because it's clouding what I want to point out. So this is a 1 year chart for EXPE, and this has a lot of things on what I spoke about today. So this is why I want to point this one out. We have resistance, resistance, resistance. We have an upward trend. We have a gap to fill. We have support becoming resistance. So we had a support level way over here. We had a support level here. We have a massive gap down. Massive gap down. And then when it pulls back, where does it stop the pullback? Prior support became resistance. So you guys tell me, is technical analysis magic? It sure seems like it. Why is it not magic? Because it's market psychology. It's telling us where people are comfortable buying a position and where people are uncomfortable holding it, so they sell it. Here's an actual trade I took based on support and resistance. This was called out by Bender in our room. Bender trades ABBV all the time. He called it out. So I'm thinking Bender likes ABBV. I'm going to pull up the chart. It was on a nice upswing. I like the positioning of the chart. This green line is where I exited. This purple, or actually the purple line was resistance from a previous day. I had that drawn from a previous time frame. The red line is where I exited. So Bender calls it out. I know he's good at ABBV. So I'm going to pull up the trade because a ticker that he trades all the time, he's calling out as a potential entry. I like that it was on an upswing, so I opened my position right here. We had this Roman candle. And this super sensitive mouse, I hit the button again. So we have this Roman candle here, and because we had a Roman candle combined with a previous resistance level, I closed out the position on the next candle, which was red. So we had this Roman candle. The next candle was red, and it was below this resistance line. That was enough for me to close the trade. It was a 22% gain. That's not a huge trade. It's not what I was looking to do with the trade. I don't want to trade for 22%. I'm not complaining, I'll take it. So I was in at 35 cents and I was out at 43 cents. So it's not a huge trade. 10 contracts would be $350 of capital to generate $430. So that's an $80 profit. I'm not going to be mad at making $80. But I don't open a trade with the intention of making 22%. I want to make a little bit more than that. But this level was drawn previously on a chart that I had. We had a Roman candle up, and the next candle was a red candle that brought me below that resistance line. And because I know Roman candles typically give back, I closed out the position. I'm willing to take 22% gain because I don't want this trade to go red. What I would really hate to do is be red 22 or green 22% and then close the trade losing money. And if I didn't close this trade out, this was a call position, look what would have happened. I would have lost money. It came back to test that very resistance line that I had. We had a wick that popped through, but it very quickly got pulled back below that resistance level, and it didn't recover the rest of the day. So, am I BSing you guys about support and resistance? Am I telling you guys stuff that I don't actually use? Am I making stuff up? Here's an example, exactly how I use support and resistance. A trade was called out, I liked the trade, so I followed it. I had this line drawn, so what I want to see is a breakthrough of this line, which it did, but it did it on a Roman candle, and I know that Roman candles will typically give that gain back. The very next candle, it did give it back, and it was below resistance. So that was enough for me to take a 26-minute trade and close it out, even though it didn't do quite what I was looking for. Was that the right decision to make? In hindsight, yes. Because look, it got back to that level, but it could not get above it. And if you're in an options contract up here and it drops down here, then it goes back up here but drops again, not only is it losing value because this contract is going against you, but the time factor means as time goes by, it's going to lose value because of time decay. So here's a perfect example of how I use support and resistance to place an actual trade, and there's an actual trade confirmation to show you 912. If you pull up your charts, if you want to see this on your platform, this green line won't be there because that's obviously my platform, but that green line is 912. You can compare my chart to yours and see that that's about 912 on your chart. 938, you can see that that's about 938 on your chart. Now, if the time frames don't match up, I am on West Coast time. So 912 is actually 1212 Eastern. So if you pull up your chart, look at 1212 and 1238, you'll see that the chart matches. This isn't Photoshop. We had a Roman candle at resistance. The next candle was giving that Roman candle back. I decided to sell because it couldn't punch through and sustain a move above resistance, so I sold it. That is a real-time example of how I use support and resistance to place trades. So, I'm not trying to show you guys stuff that's theory. I'm not trying to show you guys stuff that some guy on the internet can make money with. I'm trying to show you stuff that I use to place trades. Not all of my trades are winning trades. Support and resistance doesn't always work out the way we want it to. But if you know support and resistance and you see the countless examples I've shown you today, at this point I think it's safe to say that what I'm showing you is realistic stuff. You can believe in it, and you can use it to help with your trading. So where do we begin? I see some questions in there, so let me go back. You're holding ABBV with a loss. Okay, so let me pull up. So here's why I drew that line for ABBV. We have support over here. We have support over here. We have resistance. We have support. We have resistance. So there's something about that particular line. I might actually not, is that, no, this isn't the actual, I erased the line I was looking at. This is a different chart than the one I was looking at. So let's just say that might have been, see how this is support over here? That might be the line I was looking at today. I don't think it was. Now I'm all confused. I'm going to have to go back to the other chart. So if you're in, and now my system is slowing down because it's taking up too much memory. So here's one thing I like is that there's a support level here that it bounced off of, and it was hovering around here. You can see this candle was resistance, and now it's resistance there. So under this level, I don't like it there. If we draw support over here, we're about 20 cents away from that level. If that level breaks, see, this is where you start drilling out your time frame, and you have, I can draw out like 15 different levels of support, and it's just a matter of where do you cut it. So it depends on your risk tolerance. It depends on your account size. If you have a $3 million account and you bought $10,000 of ABBV, maybe you're willing to let it go to zero. If you have a $10,000 account and you bought $8,000 of ABBV, dumb trade, first of all. Second of all, you might have a very tight tolerance of where you want to cut it. So, we can draw all these lines on here. It's a matter of your risk tolerance of where you would cut it. Let me see if I can grab. Okay, so that level was 88.44 that I didn't like. So let me pull up 88.44. Okay, so let's... So 88.44 was the level that I didn't like, and you can see this is where it was resistance here, it was support here. This is the candle. It busted through that, but then it came back down below it. So I'm on a different time frame. If we go back to the 1 minute, now I am actually super confused myself. That's why. I'm on the wrong time frame. So this was yesterday, right? So 88.44 is the level that I have. This was resistance here. We have this candle here. This was a big Roman candle, right? We've got, this is a pretty big one too, but we've got small candles, small candles, small candles. We start moving upwards. This one here, I was watching it real time. It exploded up through this level and then it pulled back. And then the very next candle opened below and then dropped dramatically. So when I saw that it punched through here but couldn't hold and the next candle was red, that for me was my exit because I didn't like this prior resistance level still holding as resistance level. So if you're in this trade now, as far as where do you cut it, I would look at this level here. We have a support level over here at 87 and then down here at 86.77. So if we pull out even further, if it breaks below those, you're now going down here to 86.18, which at some point it just becomes too much of a loss. So you've got to look at where your stop loss tolerance is. For me, it might be the low of this candle here, because if we break below that candle, we now have a series of lower lows, which is going to confirm a downtrend. So it depends on your risk tolerance and how much you really put into that trade as far as where you want to cut it. But I don't like it too much lower than where it is now, because then you're going to get into that point where, well, the next support is down here. Well, the next one is only a few cents away. Well, the next one's only a few cents away. Well, the next one's only a few cents away. So we have a high, a lower high, a lower high, a lower high. We have a low, a lower low. If this makes a lower low again, we have a series of lower highs, lower lows, which is a confirmed downtrend. So I wouldn't want to stay in this one for too much longer. I'd want to see it bounce around this 86.75-ish area, which is the low of this candle here. Depending on your time frame, if it's a short-term trade and it moves against you further, it's going to hurt. If it's a longer-term trade, you might have more room to give it. It broke the support that, I mean, if you want to give it to, again, it depends on the time frame. So support is clearly here. The bottom of this candle is the nearest term support that I see, because there's nothing really between here and there. So support for me would be 86.76. Now, if you're in a weekly contract and you're going to give it from 87.21 to 86.76, those contracts are going to erode really quickly. Because we're towards the end of the week, it's moving against you, depending on the strike. You've got a lot of things working against you. So for me, 86.76 is support, but if it's a short-term trade, I don't know if I'd really want to see another penny drop from where it is, but you almost have to give it to 86.76 to see if it's going to test. So again, that's why I like entering close to support and resistance, because now we're giving it another 40 cents, 50 cents to see if that's going to hold. And if it doesn't hold, those contracts are going to be toast. And if they expire this week, they're definitely, I mean, I don't want to be mean or negative or anything, but that's not going to be a trade that you're going to recover from. Not that it's going to destroy your account, but that particular trade is going to be too hard to really get anything back out of. So if it's a short-term trade and we're waiting for another level down for support, it's going to be a tough trade to really come back from. For day trades or scalp, is the 10-day 5-minute. For a scalp, you don't want to do a 10-day 5-minute time frame. Scalps, again, a scalp is a really short trade for a technically it's for a large position short term. The large position means you don't have to make $4 on the trade. If you make 20 cents but you have 1,000 shares, not a good trade. If you make 20 cents but you have 400,000 shares, good trade. Right? So a scalp is typically a short-term trade with a large position. So if you're doing contracts, maybe you buy 100 contracts and you're really only looking for 15, 20 cents on those to make a good amount of money. So when we say scalp, sometimes we use it a little bit differently where we're not going in with a lot of size, but we intend for it to be a short-term trade. So for scalping, I don't want to use a 10-day 5-minute chart. I'm on the 1-minute chart. Because I'm in and out of that trade in possibly 3 minutes, 7 minutes, 9 minutes, that what happened 2 weeks ago I don't care about. I'm concerned about what's happening the last 10 minutes and the next 10 minutes. For day trading, if your time frame is a week or two out, you can use a 10-day 5-minute. If your time frame is a month or further, I wouldn't use a 10-day. I'd have the lines on 10-day, but I would know that they're 10-day 5-minute lines, if that makes any sense. So, okay, I see a comment. I didn't look at the chart or support and resistance. Yeah, if you're trading without support and resistance, you're going off of luck, hope, what someone else says. Now, if you follow some of the other traders that you know consistently make amazing trades, that might be a reason to follow them in or out of a trade. Eventually, you want to learn why did they get in and out of that trade, though. That's the important part. So if they're not here one day, you can still make those trades. So if you're new, I suggest you do follow. In fact, I don't really trade ABBV. I got into that specifically because Bender called it out. And I know he's good with ABBV, so I went into that trade. I did pull up the chart and look at it, and in fact, my entry is 3 minutes after he called it out. So he called it, and it did take me 3 minutes to pull up the chart and look at it before I decided I wanted to get in. So I followed that trade because he called it out. So it's okay to follow other traders. I don't normally follow ABBV, but I know Bender does. So if he calls it out, I know he's seeing something that's really good, positive, strong, whatever. So it's okay to follow other traders, but you do have to manage that position yourself. I didn't wait for him to tell me when to get out of the trade. I got out of it when I thought it was appropriate for me, for my risk tolerance, for my goals, for my targets, for how I trade. So it's okay to follow other traders. What you want to do is eventually pull up the chart to see support and resistance and eventually find out, okay, that's why I think they got into that trade. So don't just follow them and then dissect it to find out why did they do that. Some cash accounts do not meet PDT. So PDT is a huge pet peeve of mine. If you guys have less than $25,000, do not use margin on your account. If you do not have $25,000 and you use a cash account, you can trade as many times as you want up until your account balance. So if you have $10,000, you can trade 10 $1,000 trades without a PDT restriction. So the smaller accounts, I do recommend. Options are tough. Options can be very hard to learn for some people. If you understand options and trading, or you're in a good mentor group, and I'm biased, but I'm going to say Black Box Stocks is an amazing group of people to be around. If you trade options, the good thing is it's defined risk. If you buy a $200 contract and you let it go to zero, the most you lose is $200. So if you know $200 is your stop loss, your limit, you can open a contract for $200 and you can basically say it either goes to zero or it makes money. It's a defined risk. So without $25,000 with a cash account, you don't have to worry about PDT. And with options, they settle the next day. So let's say you have a $10,000 account and you open 10 $1,000 trades today. And you close all 10 trades today and you made, let's say, a total of $500 profit. So now your account balance is $10,500. You made 10 trades today and closed 10. So that's 10 day trades. You made $500 profit. Tomorrow, you can make as many trades as you want, up to $10,500. Your $10,000 in capital plus your $500 that you made in profit. You can use all of that. You can make 100 trades, you can make 1 trade, you can make 15 trades, up until your capital of $10,000 and $500 is used. There's no PDT restriction because it's a cash account. You get a PDT restriction when you have margin. So if you guys have PDT restrictions, please, please, please get out of margin. The reason for that is I've had a friend who used margin account and he would tell me all the time, I'm up 80%, but I can't sell. And it would drive me absolutely nuts. You can sell, first of all, hit sell, and it sells. You will get a restriction on your account, but you can get out of the position. But not selling is a choice. You're choosing not to sell because you have a PDT restriction. You can still sell it, but he would get tons of great trades. The next day he'd lose it all because he couldn't, quote unquote, couldn't sell. So please, if you have PDT restriction, and even if you want to keep margin for whatever reason, if you know this is a trade I can open but I can't close it, do not open the trade. You're hurting yourself as a trader. The long run, you're going to destroy yourself because you're forming bad habits. This is support. It's breaking. I should sell. Oop, but I can't because PDT, quote, won't let me. You're forming bad habits. So please get rid of margin. You can trade as much as you want without PDT restrictions in a cash account. And because they're options, it settles the next day. You can use that entire amount plus whatever gains you've made that very next day. Yes, please, please, please get off of Robinhood. I do know people that use it very successfully. I do know people who love the platform. The amount of things that go wrong with Robinhood, and this isn't a bash, a type of trade, a type of platform, but the amount of things that go wrong with Robinhood, there's no phone number you can call if you have a problem. So if you have $30,000 in Robinhood and you have a problem, you can't call them and get an answer. And that's all I'm going to say on Robinhood, because this isn't a seminar bashing Robinhood. But it is highly recommended from a lot of people. Do not use Robinhood. So let's go to, there's a few things I want to wrap this up with. Research. How do we find research? I want you guys to go to finviz.com, Finviz. You don't have to do it now. You don't have to use this as your primary research method, but I am going to point out this is a method of research. Over here, go to Screener. Click on that. Over here, click All. You can set up this screen for as many things as you want, depending on your type of trade. There's a certain thing I'm going to point out based on what I like to look for. The first thing, price. I don't want to trade these $1, $2 stocks. So I'm going to come over here and go over $50. Average volume, I'm going to click on this, and I like to trade anything that trades over $1 million average volume. Option short, I only trade options, so I don't want this to bring back any ticker that I can't buy options for. So I'm going to select optionable. And if you go over here to pattern, ascending triangle, wedge down, trend line support, trend line resistance strong. Everything I'm talking about today, you can use Finviz, double top, double bottom, head and shoulders, inverse head and shoulders, channel, strong, channel down, channel up. You can use Finviz to filter out and tell you only tickers that are over $50, average 1 million shares, optionable, and in this case, channel down, channel up. And it's going to give you the tickers down at the bottom that meet this criteria. Here's a word of warning. You won't always find the channels that easily. So when I say channel up, if you pick some of these, depending on the time frame, some of these you won't see an awesome channel up. Like that one you can see is a pretty clear upwards channel. Some of these, and that's probably a bad example to use, but on some of these, like a ascending triangle strong, ABC, let's see if this, see on this particular one, there, I don't on that chart see an ascending triangle. Now if I drill into the chart and look at it deeper, maybe it's there, but just basically looking at that really quick, I don't see an ascending triangle. I actually technically, no, I don't see a descending. I can see a bull flag out of that, but I don't see an ascending triangle on that chart. So I'd have to pull that chart up and look at it more closely. But finviz.com will be a perfect way for you to pull up tickers that have these patterns that I was talking about today. And if you go through them, you'll find some of them that you really like. And you can use that as your starting point if you don't know how to do technical analysis on your own and you want to see, hey, I'm reading up on head and shoulders. I don't know how to find it. This is a good point right here. You can use this to kind of pinpoint and start your search for head and shoulders. Now, let's go. Just a very few select slides left. Let me see if I can find one. Hopefully you guys can see this on your screen pretty clearly. How many concepts that we spoke about today can you find in this chart? Go ahead and type in that chat box there. Who can tell me something we spoke about today that is in that chart right there? And we're at 4 hours and 23 minutes. The goal is to wrap this up by 4.5 hours because that is insane. I promise you I didn't intend for it to take this long. So we are almost done. Quiz number 1. How many concepts that we spoke about today can you find in this particular chart that's on your screen? I will take the first answer. I don't need all of them. There's one. Previous support became new resistance. Perfect. We have support right here. It became resistance right there. What else do we see in here? There is a bear flag. I can kind of see that. That goes back to the pattern slide that I had on there. Let's go to the easy ones. Downward channel, upward channel. Downward channel. This probably is an upward channel here. If we cut this part off here, we have, there's upwards and downward trend lines in here. It's kind of hard to see on this particular chart because it's not a chart, it's a graphic, but there's definitely upward and downward trend lines. There could be, there's a potential inverse head and shoulder in there as well. So again, if you look at, the reason I have this chart up here is because I want to point out that on one particular chart, there's multiple things regarding support and resistance. It's not one concept that you can see. On one single chart, it might be a bunch of things that we spoke about today that are all on that same chart. So just because you see a head and shoulders doesn't mean you can see a double top or a double bottom. Just because you see prior support becoming resistance doesn't mean you won't find an upward or downward channel. Last quiz. Let's see if you really understand the material presented today. It looks like I did not finish this slide because I was changing them today. There should be a chart there. Let's look at the 5-year chart for CMG and tell me where you see some of these concepts. So let me jump over to a chart. Let's pull up CMG. Let's change this to, there's a 10-year chart. Let's just leave it there because I don't want to keep playing around with the charts. What do you see? What did we speak about today that you see on that chart? And since I'm on the platform, let's go. This is a trend line. We can draw a potential trend line there. We see upward movement. We can draw maybe a trend line there. Oops, that one didn't hold. There we go. You can see it bounces off this trend line each time. We can draw, obviously that one right there in the middle would be a resistance. So resistance, 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 resistance again. So there's, again, we can see a bunch of things in here on one particular chart that we spoke about today. So it's not one concept. So if you pull up a chart and you say, oh, this is a upward channel. And then you say, wait, there's also a double top. So is it bullish or bearish? You'd have to look at it and see which one is going to be the stronger pattern. And to do that, that's more advanced than a basic seminar. That's something we're going to look at as far as the volume that comes in at certain price levels. What's driving the movement? Is it a headline? Is it earnings? So there's things we're going to look at to see which is going to be a stronger pattern. Because you can have an upward trend and a double top as well. So one would be a bullish pattern, one would be bearish. So again, the point isn't a specific pattern on this chart. It's not the ticker. It's not the time frame. The point of this is that I want to point out a single chart can have multiple things that we spoke about today within the same chart. So it's one of those things where there's so many things about support and resistance that if you try and get it down in one day, you're going to miss a bunch of it. This seminar is not going to make you an expert on support and resistance. It was designed to introduce the concept and give you a ton of examples that prove it's not a one-off. It's not magic. It's not a random occurrence. It's something that's repeatable, and we look for these patterns to place our trades. We want to open on support, close on resistance, or the opposite if we're shorting something. If support breaks, we want to close out of that position and not hold on and hope. So what I wanted to do today was point out a bunch of examples that show it's not a random occurrence when we talk about buy on support, sell on resistance. It's not something Black Box made up and said when support breaks, close your position. We're not making it up. I wanted to give you tons of examples today that show there's plenty of reasons why this stuff works. We're going on 4.5 hours, guys. Where can you find me? If you're on Twitter, at 7star Mike. YouTube, 7star Traders. Type that into the search box and it'll pull up this little bug. That's how you know it's me. Instagram, at 7star Mike. If you're on Discord, 7star Mike. I'm consistent with how you can find me. If you guys like what I did today, if you guys like some of the other videos I've done, please hit that like and subscribe button. I love the support you guys have shown me. I appreciate it more than you know. It really does mean a lot to me when someone says, hey, I watched your video and I made money using one of the concepts you showed me. It really does it puts a smile on my face. One of the reasons I try to do seminars like this and put things on Twitter and put things on YouTube is Black Box helped me become a better trader. And a lot of the stuff I learned from being a part of Black Box. So when I do stuff like this, it's kind of my way to give back to someone who's been trading for 1 or 2 years, that wants to get to that level where you're at when you've been trading 4 or 5 years. And then I want to look at someone who's been trading 10 and 20 years, and I want to get to that level. And when I get there, I want to look at the person who's been trading 4 or 5 years and give them hints and tips as far as what got me from the 5-year to the 10-year level. So the things I do for Twitter, Instagram, YouTube, on Discord, it's my way of giving back to the people that helped me learn these concepts myself without having to lose $3 million blowing up accounts left and right to learn these concepts on my own. I've still taken these concepts and lost money with them. So you can tell me, this is how you should look at this is how you should look at that. I want to go in and screw it up myself and lose my own money, and then it sinks in like, hey, you dummy, you didn't have to lose money. Someone told you. I'm stubborn like that. So the repetition and the constant putting out of different content and stuff, it's really my way of giving back to people that are not trading as long as I have been. And it's reinforcing some of the stuff I've learned from people that have been trading a lot longer than me. So I enjoy putting out content for you guys. If you enjoy it as well, the likes, the subscribes, the comments, it really does mean something to me. It's not just me saying, oh, I would love it if you'd subscribe. It really does put a smile on my face when someone sends me a message and says, I watched that video you put out, I used that concept in trading, and today I made $1,000. I love hearing stuff like that. It makes me feel good to be able to help other people out. That's why I do all this. Hit the like and subscribe to let me know you enjoy, and I can put more of it out. And ladies and gentlemen, guys and gals, thank you for spending 4.5 hours with me. I did not intend for this to be anywhere near 4.5 hours. In fact, I rehearsed the coordination of the slides and the charts, and it was nowhere near 4.5 hours. But I'm a chatterbox. So thank you guys for joining me. If you have any questions, reach out on any of those ways that I said you can reach me. Ask any questions about support and resistance that I went over. Ask any questions about stuff you've heard that I didn't go over. Any questions you have. I am a friendly person. I love helping people. Helping people also, like I said, reinforces things that I'm learning. So if we can all become better traders, that just makes the community that much stronger. If I'm not sure of what I'm looking at and I say, hey guys, do you see the same thing? And 17 other traders say we see the same thing, that's just confirmation that I'm looking at the right stuff. I want us all to be able to look at a chart and say, I agree with this, let's do it. Or you're not looking at this, maybe take another view and maybe save me from making a bad trade. So the more of us that are versed in support and resistance, the more of us that are part of the family supporting each other, the better we all are as traders. Thank you guys. If you have any questions, you know how to reach me. Thank you, thank you, thank you, and enjoy the rest of your nights.